Employees Provident Fund Organization FAQ Comprehensive Guide to EPFO Fundamentals covering retirement savings, membership benefits, claim procedures, and digital services. This guide addresses frequently asked questions about the Employees Provident Fund Organization, EPFO. We provide essential information on EPF contributions, enrollment, withdrawals, and accessing EPFO's digital platform. EPFO stands as India's premier social security organization, serving millions of workers by securing their financial future. Established in 1952, EPFO administers three critical schemes: EPF, Employees Pension Scheme; EPS, and Employees Deposit-Linked Insurance, EDLI. EPF scheme facilitates systematic retirement savings for workers. EPS scheme provides pension benefits to employees and their families following retirement, disability, or death. EDLI scheme offers insurance coverage to families in the unfortunate event of a member's death during service. Both employers and employees contribute to EPF at a rate of 12% of the employee's basic wages plus dearness allowance. Establishments with fewer than 20 employees may contribute at a reduced rate of 10% in specific industries. EPFO assigns each member a universal account number, UAN, that remains permanent throughout their career transitions. Connect your UAN with Aadhaar, bank account, and PAN to leverage online services and expedite claim settlements. Members can conveniently check balances, download account statements, submit claims, and monitor application status online. The EPFO mobile application enables members to access account information seamlessly via smartphones. Members may withdraw funds for specific life events, including housing, marriage, education, medical emergencies, and retirement. After 1 month of unemployment, members can withdraw up to 75% of their accumulated savings. After 2 months, complete withdrawal is permitted. For housing loans, members can utilize up to 36 months of basic wages or 90% of their EPF balance, whichever is lower. EPFO periodically revises interest rates, typically offering more competitive returns compared to many alternative savings instruments. Accounts without contributions for 36 consecutive months become inactive but continue to earn interest. International workers employed in EPFO-covered establishments are eligible for membership, subject to special provisions based on bilateral Social Security agreements. For expedited fund disbursements, ensure your Aadhaar, PAN, and banking details are accurately updated in EPFO records. Grievances regarding EPF can be addressed through EPFO's online complaint resolution system or the Labor Ministry's centralized grievance portal. Employers' contribution responsibilities. Employers must contribute their share without deducting from employee wages or reducing salaries. EPF protection extends to all workers, including daily wage earners and piece rate employees. No deduction from employee wages. Employers cannot extract their EPF contribution share from employee wages. This violates the EPF and MP Act 1952 and can result in fines up to Rs 10,000 and imprisonment up to 3 years for repeat violations. No wage reduction. Employers cannot reduce wages to compensate for EPF contributions. Section 12 of the EPF and MP Act 1952 strictly prohibits this practice. Employees can file complaints with their regional EPF commissioner if this occurs. Protection for all workers. Daily wage and piece rate workers are eligible for EPF, with contributions calculated based on their monthly earnings. Contract workers are also entitled to coverage, with the principal employer held responsible if contractors fail to provide adequate protection. Timely payment obligation. Employers must remit both employee and employer contributions by the 15th of the following month. Delayed payments incur interest charges and penalties. For instance, May contributions must reach EPFO by June 15th. Proper documentation. Employers must maintain comprehensive records of all PF contributions, enrollments, transfers, and withdrawals for a minimum of 5 years. These documents must be readily accessible during EPFO inspections. Mandatory registration. Establishments with 20 or more employees must register with EPFO. Smaller organizations may join voluntarily. Once registered, an establishment remains covered even if employee strength falls below 20. Contribution calculation. Employers must contribute 12% of the employee's basic salary plus dearness allowance. Of this amount, 8.33% is allocated to the pension scheme and 3.67% to EPF. Certain industries with smaller workplaces may qualify for a reduced rate of 10%. Administrative charges. Beyond the primary contribution, employers must pay 0.5% of wages as administrative charges. These funds support EPFO operations and are mandatory for all establishments. EDLI contribution. Employers must contribute 0.5% of wages to the Employee Deposit-Linked Insurance (EDLI) scheme, plus 0.01% as administrative charges. This provides up to Rs 7 lakhs to nominees if a member dies during service. International worker provisions. distinct regulations apply for international workers in India. Countries with Social Security Agreements, SSAs, with India may follow different requirements to prevent dual contribution obligations. Interest on PF contributions. Members receive full interest on their PF even when contributions are delayed, while employers face penalties for late payments. Interest accrues monthly based on the annually declared rate, 8.65% for 2016-17. Full interest entitlement. Members receive complete interest even when employers delay PF deposits. Once employers pay overdue amounts, members get full interest for the entire delay period. This protection ensures employees don't lose retirement savings due to employer negligence. EPFO meticulously tracks delayed payments to guarantee proper interest compensation. Employer penalties. Late paying employers face strict penalties under Sections 7Q and 14B of the Act. These penalty rates exceed standard interest rates and accumulate rapidly. EPFO can initiate legal proceedings against repeat offenders, with serious violations potentially resulting in criminal charges carrying up to 3-year imprisonment. Interest calculation method. Interest is calculated on monthly balances at the annually announced rate. This monthly compounding maximizes member benefits. Calculations incorporate all deposits, withdrawals, and previously earned interest, with interest accruing based on the number of days funds remain in the account each month. Interest rate example. For 2016-17, the interest rate was 8.65%. The EPFO board proposes yearly rates based on investment performance, subject to Finance Ministry approval. Rates have fluctuated between 8.25% and 12% over the past 2 decades, reflecting the fund's investment performance across various asset classes. Interest payment timeline. Interest is credited annually on March 31st financial year end. Actual deposits may take 2 to 4 months pending verification and approval. Members can verify interest credits through their EPISbook after Finance Ministry approval. EPFO continues improving this process for faster crediting. Tax considerations. EPF interest typically remains tax-free, with exceptions. Interest on annual contributions exceeding 2.5 lakhs becomes taxable at your income tax rate. This threshold undergoes annual review during union budget presentations and may change. Interest on inactive accounts. Since 2016, even inactive accounts, no contributions for 36+ months, earn interest. Previously, such accounts received no interest. This policy benefits millions who changed employment or temporarily paused work. Regular account monitoring and consolidation are recommended. Emergency provisions. During crises like COVID-19, EPFO may offer special withdrawal options without affecting interest on remaining balances. These provisions are evaluated case by case, with official notifications issued as needed. International worker rules. International workers covered under EPF earn interest identically to domestic workers, though withdrawal regulations may vary based on bilateral agreements between India and their home countries. These workers should review specific country agreements and consult EPFO's International Workers Cell for guidance. Subsistence allowance and PF contribution. PF contributions are not required on subsistence allowance during suspension periods. Former employees cannot contribute to EPF, and employers face penalties if they deduct but fail to deposit employee contributions. Suspension period. During suspension, employees receive subsistence allowance, which is exempt from PF contribution requirements. The EPF and MP Act 1952 does not classify subsistence allowance as wages for PF contribution purposes. If a suspended employee is later reinstated with full pay, the employer must make PF contributions on the back pay, excluding the subsistence allowance already paid. What is subsistence allowance? A reduced payment, typically 50 to 75% of regular wages, provided to employees during disciplinary proceedings to support their basic living expenses. Reason for exemption. Section 2B of the EPF and MP Act specifically excludes suspension allowances from the definition of wages, calculation after reinstatement. For PF purposes following reinstatement, only the difference between full wages and previously paid subsistence allowance is considered. Post-employment contributions. Employees cannot contribute to EPF after termination of employment. Without ongoing wages and an employer relationship, no contributions can be collected. All member contributions require matching employer contributions. The EPF system functions based on active employer-employee relationships and ceases when employment ends. Workers should verify their EPISbook to ensure all contributions are accurately recorded before leaving a job. Alternative options. Former employees can establish Public Provident Fund, PPF, or National Pension System, NPS accounts to continue retirement savings. Job transitions. Members should transfer their PF rather than withdraw it to maintain growth of retirement savings and avoid tax implications. Inactive accounts. Per 2016 EPFO regulations, Accounts without contributions for over 36 months are classified as inactive but continue to earn interest. Unpaid contributions if PF deductions from employee wages are not remitted to EPF, the EPFO will impose penalties and initiate collection from the employer. Affected employees can file complaints with the police under sections 406/409 of the Indian Penal Code. Employers face legal consequences for breach of trust and misappropriation of employee funds. Workers can monitor their PF contributions through the EPFO website and should promptly report any discrepancies. The EPFO conducts regular audits to identify non-compliance and unpaid contributions. Time limitations. High Court rulings confirm there is no time limit for recovering PF dues. The EPFO can collect dues dating back to when the establishment was first covered. Personal liability. In certain cases, company directors and partners can be held personally responsible for non-payment of PF dues. Recovery process. The EPFO follows systematic procedures including notices, assessment of amounts due, and recovery through bank account freezes and property attachment, if necessary. Legal framework. The EPF and MP Act 1952 mandates contributions from both employees and employers for eligible workers. Employers must deduct the employee's portion and remit the total contribution to the EPFO. Non-compliance constitutes a legal violation subject to penalties, interest charges, and potential criminal prosecution. Enforcement authority. EPFO offices nationwide enforce compliance, with the Central Provident Fund Commissioner serving as the highest authority. Statute of limitations. While there's no time limit for recovering PF dues, legal prosecution must commence within 5 years of the offense. Appeal procedure. Employers may appeal EPFO decisions to the Employees Provident Fund Appellate Tribunal within 60 days, with further recourse available through higher courts. Employer obligations. Employers must file monthly electronic challenge-cum returns, ECR, by the 15th of the following month, and make timely payments to avoid penalties. Impact of non-payment by employer. When employers default on PF contributions, employees face reduced benefits while employers risk severe penalties. The law provides robust recovery mechanisms and safeguards to protect employee retirement funds. Key impacts and protections include reduced member benefits. If your employer fails to deposit full contributions, your retirement corpus will be smaller than expected. You'll only receive benefits based on the amounts actually deposited to your account, potentially compromising your financial security in retirement. Protection against employer claims. Under Section 32 of the EPF and MP Act 1952, employers cannot recover any debts from your PF account. Your retirement savings remain fully protected from such encroachments regardless of other financial disputes. Powerful recovery mechanisms. The EPFO can employ multiple enforcement tools against defaulting employers, including freezing bank accounts, attaching receivables, auctioning property, and in serious cases, issuing arrest warrants. These measures ensure retirement funds remain secure even when employers default. Verification systems. Members should regularly check their annual PF statement or EPISBook through the EPFO portal to verify correct contributions. Early detection through vigilant monitoring helps protect your long-term financial interests and enables timely complaint filing. Additional consequences for employers' financial penalties. Defaulting employers face substantial costs, including 12% annual interest plus damages of up to 100% of the outstanding amount. These penalties increase progressively with the duration of default, creating strong financial incentives for compliance. Legal prosecution. Persistent defaulters risk criminal charges with penalties of up to 3 years imprisonment and $10,000 in fines. Importantly, company directors can be held personally liable, extending accountability beyond the corporate entity. Business restrictions. Non-compliant employers may be barred from participating in government and private tenders, significantly limiting their business opportunities and affecting company growth prospects. Reputational damage. The EPFO periodically publishes the names of defaulting companies in mainstream media and online platforms, causing lasting damage to business reputation and stakeholder relationships. Preventive measures. Systematic inspections. The EPFO conducts regular compliance audits, examining employment records and payment histories to ensure adherence to statutory requirements. Digital surveillance. Advanced monitoring systems track payment patterns and flag irregularities for investigation, enabling proactive enforcement before major defaults occur. Whistleblower protection. Employees reporting PF violations receive legal protection against retaliatory actions. Anonymous reporting channels ensure workers can safely report compliance issues without fear of repercussions. Employer awareness programs. The EPFO conducts educational workshops targeting small and medium enterprises to improve understanding of compliance requirements and prevent unintentional violations. Third-party verification. Certified professionals provide independent compliance verification, creating additional accountability layers within the Provident Fund system. Precedent-setting cases, landmark judgments. Recent court decisions have strengthened enforcement frameworks, notably a 2019 Supreme Court ruling that clarified calculation methodologies and expanded the contribution base. Enforcement successes. The EPFO has demonstrated its recovery capabilities by collecting substantial sums from defaulters, including 25 crores from a single corporate group in 2022, through coordinated legal actions. Protection of Provident Fund. Your Provident Fund is safeguarded by robust legal provisions that protect it from court seizures, grant it priority during employer bankruptcy, and ensure contributions even when wages remain unpaid. These comprehensive legal shields preserve your retirement savings throughout your career. The Provident Fund benefits from these critical legal protections: immunity from court actions. Under Section 10 of the EPF and MP Act 1952, courts cannot seize your Provident Fund. This shields your retirement savings from any legal claims, ensuring they remain intact even if you face lawsuits or debt recovery proceedings. Preferential status in bankruptcy. When employers face insolvency or closure, PF contributions receive priority payment status over most other creditors. This safeguards your retirement funds even during your employer's financial distress. Independent of wage collection. Employers must deposit your PF contribution, regardless of whether you've collected your wages. This ensures continuous growth of your retirement savings independent of wage payment status. Non-transferable rights. The law prohibits transferring your PF benefits to any third party under any circumstances. This prevents misuse through pledging or assignment of your retirement funds. Exemption from tax recovery. Your PF account enjoys special protection from tax authorities, granting it complete immunity from tax recovery actions. This elevates PF above standard financial assets in terms of legal protection. Segregated from employer assets. PF contributions are maintained in a separate trust, isolating them from your employer's finances even during ownership changes or corporate restructuring. This creates an effective legal firewall between company finances and your retirement savings. Streamlined inheritance process. Upon a member's death, PF funds transfer directly to nominees or legal heirs through simplified procedures. The nomination system facilitates swift disbursement to beneficiaries without complex legal processes. Withdrawal restrictions. While advances are permitted for specific needs, such as housing or medical emergencies, strict regulations limit withdrawal amounts. These constraints protect your retirement corpus from premature depletion. Stringent employer penalties. Employers who deduct but fail to deposit PF contributions face severe criminal sanctions, including imprisonment. These penalties extend personally to company directors, ensuring accountability. No statutory limitation. Unlike most financial claims that expire after a prescribed period, PF claims remain valid indefinitely. You or your beneficiaries can't claim PF benefits regardless of how much time has passed. This multi-layered legal framework creates an exceptional security system that preserves your retirement savings throughout your working years and guarantees their availability when needed during retirement. These robust protections establish the Provident Fund as one of India's most secure financial instruments for workers. Voluntary contributions. Members can contribute beyond the mandatory 12% rate, either by increasing contributions on standard wages, capped at $15,000, or by contributing on higher wages with authorization. While employees can enhance their contributions, employers may maintain only the minimum required amount. The Employee Provident Fund scheme enables members to contribute above the mandatory amount, significantly enhancing their retirement savings. This voluntary contribution option provides an excellent avenue for long-term wealth creation with tax advantages. Higher contribution rate. Members can contribute beyond the standard 12% of wages, up to Rs. 15,000. The combined contribution, mandatory plus voluntary, can reach Rs. 15,000 monthly, substantially boosting retirement funds with tax benefits. These supplementary contributions are recorded as Voluntary Provident Fund, VPF, within the same EPF account. Employer contribution. Employers may maintain their contribution at the minimum rate, while employees increase theirs. This arrangement should be formally documented and communicated to the PF office. While employers aren't obligated to match these additional contributions, some may do so as an employee benefit. Higher wage contributions. With a PFC/RPFC approval, members can contribute based on wages exceeding Rs. 15,000. This benefits higher-income employees seeking to maximize retirement savings. To initiate this, submit Form 1, revised, with a declaration of willingness to contribute on higher wages. Contribution verification. Members can request their contribution records, Form 3A ECR copy, from employers to verify accurate deductions. Online verification is also available through the Universal Account Number (UAN) portal, with SMS alerts for new contributions. Tax benefits. Voluntary contributions receive identical tax benefits as mandatory contributions under Section 80C of the Income Tax Act, with a maximum deduction of 1 rupee, 5 lakhs annually. Interest earned on contributions remains tax-free up to specified limits, while interest on excess contributions may be taxable per recent regulations. Withdrawal regulations. Voluntary contributions follow identical withdrawal guidelines as regular contributions, with specific provisions for education, housing, or medical needs. Complete withdrawal is typically permitted only at retirement, age 58, or after 2 months of unemployment. Interest accrual. Voluntary contributions earn the same interest rate as mandatory contributions, determined annually by the EPFO. Unlike market-linked investments, EPF provides guaranteed returns, typically ranging between 8 and 9% annually. Interest is calculated and credited at the end of each financial year. Adjusting contributions. Members can modify their voluntary contribution amount anytime by informing their employer. Most employers require 1 month's notice for such changes. Some organizations permit modifications only at specific intervals, such as the beginning of a financial year. Documentation requirements. To initiate voluntary contributions, members must submit a written application to their employer specifying their desired additional contribution amount. Employers must acknowledge this request and implement payroll adjustments accordingly. International workers. For international workers covered under EPF through special provisions or agreements, different rules may apply to voluntary contributions. These individuals should review the specific regulations applicable to their country of origin before making additional contributions. Before increasing EPF contributions, members should evaluate their financial objectives and current circumstances, as these funds generally remain locked until retirement or until specific conditions are met. It's advisable to establish an emergency fund and eliminate high-interest debt before enhancing EPF contributions. Even modest regular additional contributions can substantially improve retirement security over time. For instance, an extra 1 rupee, 000 monthly over 30 years can add approximately Rs. 15-20 lakhs to retirement savings, depending on prevailing interest rates. For individuals in higher tax brackets, voluntary EPF contributions represent one of the most tax-efficient investment options, offering security, competitive returns, and tax advantages. Nevertheless, diversifying investments across various asset classes remains prudent for optimizing returns and managing risk exposure.
Contract Employees Protection. Principal employers must verify contractors' EPF compliance, monitor contribution payments, and facilitate UAN activation to safeguard workers' benefits. Principal employers have these essential responsibilities regarding contract workers. Legal responsibility. Under Section 8A of the EPF Act, principal employers bear ultimate responsibility for ensuring contractors comply with EPF regulations. This liability cannot be delegated or transferred to another entity. Invoice verification. Principal employers should release contractor payments only after confirming EPF enrollment of all eligible workers. This includes verifying active EPF codes and regular contribution remittances. Implementing a prepayment verification protocol can streamline this process. Systematic monitoring. Principal employers can verify contributions and worker registrations through the establishment search feature on www.ipfindia.gov.in. Regular audits prevent compliance gaps. Quarterly reviews are recommended to identify issues before they escalate. UAN facilitation. Assisting contract workers with Universal Account Number. UAN activation enables early detection of compliance issues. UAN empowers workers to independently track their contributions. Principal employers should consider organizing UAN activation workshops. Documentation. Principal employers should maintain comprehensive records of contracts, worker details, and compliance certifications as evidence of due diligence. Documentation should include EPF payment receipts, return filings, and periodic compliance declarations from contractors. Retain these records for a minimum of 7 years. Liability implications. If contractors default on contributions, principal employers may be required to cover outstanding amounts plus interest and penalties. EPF authorities can recover dues from either party, with 12% annual interest and penalties up to 100% of the defaulted amount. Contractor compliance. Principal employers should confirm that contractors maintain separate EPF registration codes for each contract as mandated by regulations. This prevents contribution evasion and ensures accurate service records for workers. Worker awareness. Principal employers should ensure contract workers understand their EPF entitlements and contribution verification methods. Regular information sessions and multilingual materials enhance compliance and reduce grievances. Contractual safeguards. principal employers should incorporate explicit EPF compliance clauses in service agreements, including financial penalties and contract termination provisions for repeated non-compliance. Compliance technology. Implementing digital monitoring systems provides real-time visibility of contractor EPF contributions. Advanced organizations utilize dashboards that track multiple contractors and generate alerts for missed payments. Statutory filing verification. Principal employers should confirm timely submission of all mandatory EPF returns by contractors. Delayed filings incur penalties and may indicate financial instability within the contractor's operations. These measures ensure contract workers receive statutory benefits, while protecting principal employers from legal consequences arising from contractor defaults. Effective coordination between HR, finance, and compliance departments is crucial for successful implementation. Organizations typically find that proactive investment in compliance monitoring prevents significant legal liabilities and financial penalties in the long term. Pension fund contributions. Pension funds come from your employer's PF contribution, are mandatory by law, continue throughout your employment, and revert to your PF account when pension membership ends. Key points about pension fund contributions. Allocation from employer share. 8.33% of your employer's contribution is directed to your pension fund, with the remaining 3.67% of their 12% contribution going to your PF account. Mandatory by law. This contribution is required for all eligible employees under the EPF scheme and cannot be opted out of. Continuous throughout employment. Your employer must continue these contributions for as long as you remain employed, regardless of your age, even beyond retirement age. Automatic reversion to PF. If your pension scheme membership terminates, the employer's 8.33% contribution automatically redirects to your PF account without requiring any action from you. Capped contributions. Pension contributions are limited to 8.33% of Rs. 15,000, or your actual wage, whichever is lower, resulting in a maximum monthly contribution of Rs. 1,250, unless you and your employer agree to contribute based on a higher wage. Government subsidy. The Indian government contributes an additional 1.16% of your eligible wage to enhance your pension benefits. Retirement benefit calculation. Your final pension amount is determined by your contribution duration and salary history, making consistent contributions essential for better retirement benefits. International worker provisions. Different rules may apply if you're from a country that has a social security agreement with India. Restricted early access. Unlike PF funds, pension contributions cannot be withdrawn before retirement except in cases of permanent disability. Evolving regulations. The pension scheme has undergone several revisions since its 1995 inception. Staying informed about these changes helps you understand your entitlements. Tax advantages. Pension fund contributions enjoy tax exemptions when contributed and grow tax-free until withdrawal, similar to PF contributions. Portability between employers. When changing jobs, ensure you transfer your pension account alongside your PF account to maintain continuous pension benefits. Understanding these pension regulations enables better retirement planning and ensures your employer complies with legal requirements. Regularly verify your pension contributions through the UAN portal to confirm they're being correctly credited to your account. Claim settlement process. PF claims should be settled within 20 days. If delayed, you can file complaints through EPFIMS online or meet with the commissioner during monthly public sessions. Claim resolution options. Timely settlement. When your PF claim exceeds the 20-day processing period, contact the regional PF commissioner or file a complaint on EPFIMS. With complete documentation, standard processing takes just 10 to 15 days. Online complaint. Submit your concerns at http://epfigmes.gov.in to receive a tracking reference number. Save this number for all future communications and attach relevant supporting documents to strengthen your case. In-person resolution. Meet the commissioner during the monthly NIDHI Opt NICIT program held on the 10th. Arrive early with complete documentation, including your PF account details and claim submission proof, as consultations operate on a first-come basis. Escalation process. For unresolved complaints, escalate to higher authorities such as the Regional or Central Provident Fund Commissioner. Include all previous reference numbers and correspondence dates for efficient review, typically completed within 15 working days. Documentation requirements. Ensure all forms are thoroughly completed, properly signed, and accompanied by required documents like bank details and identification proof. Incomplete documentation remains the primary cause of settlement delays. Interest considerations. Your PF balance continues to earn interest until final settlement, even beyond the standard 20-day processing period, protecting your funds from processing delays. Digital verification. Claims submitted with Aadhaar verified digital signatures enjoy expedited processing of 5 to 7 working days, as they bypass physical verification requirements. Status tracking. Monitor your claim status through the EPF member portal or UMANG mobile app regularly, as the system may not automatically notify you about processing issues or requirements. Maximize your service experience by keeping your UAN, Universal Account Number activated, and KYC details current. EPFO sends SMS alerts about claim status to your registered mobile number, so maintain updated contact information, especially when relocating or changing employment, to prevent communication gaps that could delay your settlement process. Withdrawal time limits. PF withdrawals require a 2-month waiting period after resignation, proper authorization from employer or bank, and can be expedited with UAN activation linked to Aadhaar and bank details. Understanding these requirements ensures a smooth withdrawal process. PF withdrawal requirements. Resignation waiting period. After resigning, not retiring, you must wait 2 months before withdrawing your PF funds. This period allows for complete verification and final calculations, including accrued interest and employer contributions. Employer authorization. Your employer must endorse your application form. If disputes arise, you can obtain your bank's signature instead, and submit an explanation to the regional PF commissioner. Proper authorization is critical for many claims are rejected due to incorrect signatures. UAN-based claims. With an activated universal account number linked to your bank account and Aadhaar, you can submit claims with just your signature. This streamlined process reduces processing time from 20 days to approximately 10 days, with SMS updates on your claim status. Required documentation. Submit Form 19 for PF withdrawal and Form 10C for pension scheme certification. Include a cancelled check or bank passbook copy. Additional requirements may include identification, PAN card, voter ID, address verification, and your employer's resignation acceptance letter. Partial withdrawals. For specific needs, housing, education, medical emergencies, you can withdraw portions of your PF without resigning, subject to eligibility conditions. Supporting documentation is necessary for property papers for housing withdrawals or medical certificates for health-related claims. Online submission. The EPFO portal now supports online withdrawal claims, requiring your registered mobile number and active UAN. Online applications minimize paperwork and enable real-time claim tracking. Tax implications. Withdrawing PF before completing 5 years of continuous service incurs income tax liability. Exemptions apply for health-related exits or company closures. Consider these tax consequences before early withdrawal. International workers. Special provisions apply to international workers covered by Social Security agreements. You may withdraw your PF upon completion of your Indian work assignment, depending on bilateral country agreements. Inactive accounts. Accounts without contributions for over 36 months become inactive. While you can still claim these funds, additional verification and documentation from previous employers will be required. Before initiating withdrawal, verify all your details in the UAN portal to prevent delays. Maintain accurate employment records and communication with employers to resolve any authorization issues promptly. Since EPFO periodically updates regulations, check their official website for current guidelines before submitting claims. Account transfer process. When changing jobs, transfer your PF account using either paper forms or online submission with proper documentation. This process preserves your continuous service record and maintains benefits from your previous employment. Process steps. Employment change. Transfer your PF account to your new workplace by submitting Form 13R. When changing jobs, complete all details from both employers, including PF account numbers and employment dates. Initiate this process within 2-3 months of joining your new company to maintain continuous benefits and avoid interest losses. 1. Required documents. Prepare address proof, Aadhaar card, utility bills, or rental agreement, identity proof, PAN card, voter ID, or passport, and banking details, cancelled check, or passbook copy. Ensure your previous employment details are accurate to prevent delays. All document copies must be self-attested, and originals may be required during submission. 2. Online transfer. If you have an activated UAN with verified KYC, use the unified portal for faster online transfers. Simply log into the UAN portal, select online transfer claim, verify your pre-populated employment details, and submit. You'll receive status updates via email and SMS throughout the process. 3. Processing time. Typical transfers complete within 20 to 30 days after submission. Track your transfer status through the unified portal using your UAN. Expect potential delays during peak periods, February-March, if documentation is incomplete, or if employer records show discrepancies. For urgent transfers, submit a written request to your regional PF commissioner. 4. Transfer certificate. Request a transfer certificate, Annexure K documenting your complete transfer details. This certificate serves as proof of transfer completion and records your contributions, accrued interest, and service period. Maintain this certificate with your employment records for at least 7 years. 5. Common problems. Transfers may be rejected due to incomplete forms, mismatched information, or pending KYC verification. Contact your EPFO office or HR department if this occurs. Other frequent issues include name or birth date inconsistencies, inactive UAN, missing employer signatures, premature submission before leaving your previous job, or technical difficulties during high-traffic periods. Most issues can be resolved by submitting a correction request with supporting documentation. 6. Auto transfer option. When your previous and current workplaces share the same PF trust or EPFO office, you may qualify for auto transfer. This feature automatically transfers your PF balance when you provide your previous PF account details to your new employer. Consult your HR department about this option's availability. 7. International transfers. Special transfer options exist if you're relocating internationally or joining a company in a country with a Social Security Agreement (SSA) with India. These agreements combine contribution periods and prevent double Social Security payments. For international transfer guidance, consult the International Workers Cell at your regional EPFO office. 8. Multiple accounts. Consolidate several inactive PF accounts from previous employment during transfer using Form 13(R), which allows listing multiple previous accounts. This simplifies account management and ensures you retain benefits from all accounts. Gather all previous PF account details before starting the consolidation process. 9. After transfer verification. Once your transfer completes, confirm that the correct amount transferred to your current PF account. Review the passbook section on the unified portal or request a statement from your current employer. Report any discrepancies immediately to both employers and your EPFO office. 10. Maintain comprehensive records of all PF transactions, including contributions, transfers, and withdrawals. Regularly review your PF statements to identify and address any discrepancies promptly, safeguarding your retirement funds. Additionally, preserve employment certificates and relieving letters from all previous employers to facilitate smoother processing of PF transfers and other benefits. Interest crediting method. PF interest accrues monthly based on government-established rates, with 8.65% applied for 2016-17. Housing assistance is exclusively available through non-refundable withdrawals, rather than loans. Monthly running balance interest accrues based on your monthly balance at the government-determined annual rate. This calculation includes both your contributions and your employer's contributions from their deposit date. This transparent system ensures fairness by accounting for any fluctuations in contribution amounts throughout the year. Annual rate setting. The government established an 8.65% interest rate for 2016-17, with new rates determined annually based on economic conditions and fund performance. Previous rates included 8.80% 2015-16, 8.75% 2014-15, and 8.50% 2013-14. The EPFO board proposes the rate, which requires final approval from the Finance Ministry. Housing withdrawals. While refundable loans aren't available for housing purposes, you can access non-refundable withdrawals. These allow you to withdraw up to 36 months of basic wages plus allowances, or 90% of your balance, whichever is less. For home purchase or construction, eligibility requires a minimum of 5 years of service, and the property must be registered in your name or jointly with your spouse. Interest calculation method. Interest is computed on your balance at the beginning of each month plus any contributions made before the 15th. Contributions deposited after this date earn interest starting the following month. All accrued interest is credited to accounts at the financial year end, March 31st. The calculation follows this formula: monthly starting balance plus contributions before 15th, x annual interest rate %. 12. Account verification. Review your account statements annually to verify the accuracy of all contributions and interest credits. Report any discrepancies to your employer or the EPFO within 30 days of discovery. Access your statements conveniently online using your UAN. Inactive accounts. Accounts without contributions for 36 consecutive months are classified as inoperative, While these accounts continue to earn interest, it's advisable to transfer or withdraw these funds. Note that different regulations may apply to accounts that become inactive following retirement. Taxation implications: PF interest earnings generally remain tax-exempt up to certain thresholds. Currently, interest earned on employee contributions exceeding 2.5 lakhs annually is subject to taxation. Consult a tax professional regarding your specific circumstances. Fund withdrawal process: when claiming your PF, final interest calculations extend to the month preceding settlement. The processing typically requires 15 to 30 days after claim submission. Ensure all your details, particularly banking information, are accurate to prevent processing delays. PF Act applicability: the Provident Fund Act applies to entire establishments, making all eligible workers entitled to membership regardless of their work location. Employees denied membership have rights to seek assistance from employers or authorities, and can take legal steps to ensure compliance. Membership requirements: workers become eligible for PF membership only after the Act applies to their establishment, which happens when specific criteria are met. Employees denied membership can approach their employer or the Regional Provident Fund Commissioner for assistance. The Commissioner is authorized to investigate and enforce compliance. Workers may file complaints through the EPF portal or submit written complaints to the Regional PF office. Most issues are resolved within 30 days. The Act covers an entire establishment, including all departments, branches, and units under the same PF code number. All eligible employees qualify for membership regardless of their work location, including remote workers, employees at different branches, and those on temporary assignments. Qualifying contract and temporary workers are entitled to PF benefits regardless of their employment duration. Establishment coverage: the Act applies to establishments with 20 or more employees working in industries listed in Schedule I of the Act. Schedule I encompasses industries such as cement, cigarettes, engineering, iron and steel, paper, textiles, and other sectors specified by the government. Under the once covered, always covered principle, establishments remain under the Act even if employee count falls below 20. Establishments with fewer than 20 employees may voluntarily come under the Act if the employer and a majority of workers agree. Certain small establishments, such as cooperative societies with fewer than 50 workers operating without power, may qualify for exemption. Implementation process: employers must register with the EPFO within 1 month of becoming eligible. Registration can be completed online through the EPFO's unified portal, streamlining the process for employers. Every eligible employee must be enrolled and assigned a Universal Account Number, UAN. The UAN remains constant throughout an employee's career, facilitating PF account portability when changing jobs. Contribution deductions must commence from the employee's first salary after eligibility. Employers must remit monthly contributions by the 15th of the following month. Electronic Chalancome Return, ECR, must be filed monthly alongside contribution payments. Non-compliance consequences: failure to register an eligible establishment may lead to prosecution under Section 14 of the EPF and MP Act 1952. Late contributions incur 12% annual interest and penalties of up to 100% of the amount due. Willful evasion of PF payments constitutes a criminal offense punishable by up to 3 years imprisonment and fines of up to Rs 10,000. The EPFO conducts regular inspections to ensure compliance, and employers must maintain proper records for at least 5 years. Employees can verify their PF contributions through the EPFO website or app, enabling them to report discrepancies. Multiple employment membership: EPF membership operates independently for each employer, has no upper age limit, though pension eligibility ends at 58, applies to employees earning below Rs 15,000, and excludes apprentices. Understanding these provisions ensures proper benefit administration for those working multiple jobs. Separate accounts: when working for multiple companies, you maintain distinct PF account numbers for each employment. Each employer contributes separately, with benefits calculated independently per job, potentially enhancing your retirement savings. No age restriction: the Provident Fund has no maximum age limit for enrollment. However, pension fund membership is restricted to those under 58 years. If you're above 58, your contributions go solely to EPF, not EPS, and your employer's pension contribution is redirected to your EPF account. Wage limits: eligibility for membership requires basic wages, plus dearness allowance, not exceeding Rs 15,000. Once enrolled, your membership continues, even if your compensation later surpasses this threshold. For multiple employments, this wage ceiling applies independently to each position. Apprentice exclusion: apprentices are ineligible for EPF membership. However, enrollment becomes mandatory immediately upon completion of apprenticeship. regardless of whether you continue with the same employer or join another organization. International workers, employees from countries having social security agreements with India may be exempt from EPF if they contribute to their home country's social security system with proper documentation. Workers from non-agreement countries must participate in EPF regardless of salary level. Each Indian employment is evaluated separately for EPF purposes. Transfer of accounts. When transitioning between employers, you can transfer your EPF account rather than withdrawing funds. This preserves your service continuity for pension eligibility and prevents potential tax liabilities. Transfers can be initiated online through the EPFO portal or via your employer. Minimum service requirement. EPF enrollment has no minimum employment duration prerequisite. Eligible employees must be registered from their first workday, with contributions commencing from their initial paycheck. This requirement extends to temporary positions as well. Part-time employment. If you hold multiple part-time positions, you can participate in EPF at each workplace where you meet eligibility criteria. Contribution calculations are based on your earnings from each respective employer. Contractual employment. Contract workers employed across multiple establishments must be enrolled separately by each contractor when eligible. The principal employer bears responsibility for ensuring contractor compliance and becomes liable if contractors fail to fulfill their obligations. Verification process. The EPFO periodically reviews employees with multiple EPF accounts to prevent misuse. Maintain comprehensive records of all your employments and corresponding PF account numbers to avoid complications. Benefit calculation. Upon retirement or claim submission, benefits for multiple EPF accounts are calculated individually unless consolidated. Consider unifying multiple accounts under a single universal account number, UAN, for streamlined management.
High-wage employees and PF employees earning above Rs 15,000 can opt into PF with mutual employer agreement within 6 months of joining. Though not mandatory, PF provides substantial retirement benefits and tax advantages worth considering. Optional membership. Employees earning over Rs 15,000, Basic plus DA, aren't required to join PF if they don't have existing membership. This threshold applies only to basic wages, dearness allowance, and retaining allowance. Those below this limit must enroll, while higher earners can choose voluntary enrollment. High-wage employees can join PF with mutual consent from their employer by exercising the option under Para 26(6) of the PF scheme. The employer must agree to deduct the employee's contribution and provide matching funds. This agreement requires proper documentation with the EPFO. Time constraint. The enrollment option must be submitted within 6 months of employment. Late applications require special approval from the regional PF commissioner, including justification for the delay and potentially additional documentation from both parties. Contribution options. Voluntary members can contribute based on either the Rs 15,000 statutory limit or their actual higher wages if the employer agrees. Contributing on actual wages means both the employee's 12% and the employer's matching contribution are calculated on the higher amount, significantly increasing retirement savings. Tax advantages. Voluntary PF contributions qualify for tax deductions under Section 80C. The interest earned remains tax-free, and withdrawals after specified service periods are also tax-exempt, creating a triple tax advantage, that benefits even high-income employees. Withdrawal guidelines. Voluntary members follow identical withdrawal rules as mandatory members. Partial withdrawals are permitted for specific needs including housing, education, medical treatment, and marriage, subject to eligibility criteria. Membership continuity. Once enrolled, high-wage employees must maintain membership until employment termination or retirement. This ensures consistent contributions and prevents intermittent participation. Discontinuing contributions violates the EPF Act and may trigger penalties. Interest benefits. EPF typically offers higher interest rates than most government savings schemes and bank fixed deposits. This provides high-wage employees a secure investment with competitive returns, particularly valuable during market volatility. Rates undergo annual review by the Central Board of Trustees. International workers. High-wage international employees from countries with Social Security Agreements, SSAs, with India may qualify for special provisions. These workers should consult both EPFO and their home country's Social Security Administration to understand cross-border benefit coordination. Transfer and re-enrollment. PF membership requires valid wages. Transfers necessitate re-enrollment at new employers, and pension scheme participation is contingent upon active PF membership. Transfer process. When transitioning to a new workplace, employees must enroll with their new employer to transfer their PF account. This ensures continuity of PF benefits throughout their career. Employees should initiate the transfer process within 2 months of joining their new organization to avoid administrative complications. Transfer documentation. Complete Form 13 for PF transfers and submit it through your new employer. This can be done digitally through the member portal or via your employer's HR department. Essential documents include your UAN card, previous employment details, and valid identity proofs. Wage requirement. Only individuals receiving statutory wages qualify for PF membership. Contractors or consultants paid professional fees without formal wages are ineligible. Wages specifically comprise basic salary, dearness allowance, and retaining allowance, excluding bonuses and other variable components. Enrollment timeline. Following transfer, complete the re-enrollment process within 30 days of joining to maintain uninterrupted PF benefits. Delayed enrollment may adversely affect interest calculations and create gaps in pension service records. Employers are obligated to facilitate timely enrollment. Pension scheme linkage. Pension scheme membership is inseparable from PF enrollment, for you cannot participate in one without the other. Pension benefits accrue based on your cumulative service across multiple employers, provided all transfers are properly executed. Universal Account Number, UAN. The UAN significantly streamlines transfers between employers. Employees can link their new employment to their existing UAN, simplifying transitions between organizations. Your UAN remains constant throughout your career, substantially reducing administrative paperwork. Interstate transfers. Transfers between employers in different states typically require additional documentation. PF offices in both jurisdictions coordinate to transfer your funds and service records. Interstate transfers generally require 30 to 45 days for completion, longer than intrastate transfers. Transfer rejection cases. PF transfer applications may be rejected due to incomplete information, inconsistent personal details, or identity verification discrepancies. Upon rejection, correct the identified errors and resubmit your application. Common issues include name birthday inconsistencies, incomplete employment history, or signature verification failures. Impact on withdrawals. During the transfer process, partial withdrawals from your PF account are temporarily suspended. All withdrawal requests remain pending until the transfer concludes. This safeguard ensures accurate balance transfers and prevents duplicate claims. High-wage employees and pension employees joining with wages above Rs. 15,000/month can opt into the Provident Fund, but are ineligible for the pension fund. Their entire 24% contribution is allocated exclusively to the Provident Fund. New employees above wage ceiling. Since September 1, 2014, employees with a basic wage exceeding Rs. 15,000/month can voluntarily join the Provident Fund upon request. This provision offers high-earning professionals valuable retirement savings opportunities. Pension fund exclusion. These high-wage employees are ineligible for the pension fund. This restriction helps maintain the pension system's financial sustainability for lower and middle-income workers. Contribution allocation. For these employees, both the employees' 12% and employers' 12% contributions are directed entirely to the Provident Fund. This differs from standard members, earning below Rs. 15,000, where a portion of the employer's contribution is allocated to pension. Voluntary membership commitment. While enrollment is optional for high-wage employees, once they opt in, they must continue participation throughout their tenure at that workplace, ensuring consistent retirement savings. Wage fluctuations. If an employee's wages subsequently fall below Rs. 15,000, they become eligible for the pension scheme. Conversely, if existing members' wages rise above this threshold, they continue receiving pension benefits based on the ceiling amount. Documentation requirements. High-wage employees joining PF must complete Form 11, with a declaration of voluntary participation. Employers are obligated to maintain these records for EPFO audits. Tax advantages. PF contributions by high-wage employees qualify for tax deductions under Section 80C of the Income Tax Act. Additionally, the interest earned remains tax-exempt, enhancing its appeal as an investment vehicle. Supplemental contributions. High-wage employees can make additional voluntary contributions beyond the mandatory 12% through the Voluntary Provident Fund, VPF, though employers are not required to match these supplemental amounts. International workers. Distinct regulations may apply to international workers from countries with bilateral agreements with India. Their eligibility is determined by the specific terms of these agreements. Employer obligations. Employers must maintain separate documentation for high-wage employees who participate in PF and record their consent. failure to maintain proper records may result in regulatory penalties. The Rs. 15,000 wage ceiling established in 2014 aims to ensure pension fund sustainability while providing comprehensive retirement benefits across income levels. Prior to this adjustment, the ceiling was set at 6,500 rupees. Although the EPFO periodically reviews this threshold, it has remained unchanged since 2014, despite recommendations to increase it in response to rising living costs and wage inflation. Post-retirement membership (EPF) membership is mandatory for eligible employees, cannot be terminated during employment, and continues post-retirement if the employee remains employed. Essential aspects of EPF membership. Post-retirement continuation. Your PF membership can extend beyond retirement age if you continue working. This applies whether you remain with your current employer or join another organization covered by the EPF Act. Standard PF deductions will continue from your post-retirement salary. Mandatory enrollment. EPF membership isn't optional for eligible employees. Once you meet eligibility criteria, enrollment is automatic. Employers are legally responsible for enrolling all qualifying employees. Uninterrupted membership. You cannot opt out of EPF while employed. Contributions must continue until either employment termination or reaching age 58, whichever occurs later. Attempting to discontinue while employed violates EPF Act provisions. Withdrawal regulations. Complete EPF withdrawal is typically permitted only upon retirement. Partial withdrawals are available for specific needs including housing, education, medical emergencies, or marriage. Full withdrawal requires a minimum 12-month unemployment period. Account portability. When changing employers, transfer your EPF account to maintain service continuity. This can be done online through the official member portal or through your employer. Transfers preserve your service duration, critical for pension calculations, and ensure continuous interest accrual. Pension eligibility. Members with over 10 years of service qualify for pension benefits under the Employees Pension Scheme (EPS). Your pension amount is calculated based on salary history and total service years. Interest benefits. Your EPF balance continues earning government-determined interest rates even during post-retirement employment. This interest remains tax-exempt up to specified limits, enhancing its value as a retirement savings vehicle. Survivor benefits. In case of a member's death, nominees or legal heirs receive the accumulated EPF balance plus insurance benefits under the EDLI scheme, providing crucial financial protection for families. International worker provisions. International workers are subject to specialized regulations with distinct withdrawal policies based on bilateral social security agreements. Contribution requirements and benefit structures may vary for these employees. Digital management. Members can monitor their EPF accounts, submit claims, and verify contribution history through online portals or the mobile application. Digital nominations and ECIC have streamlined account administration and claims processing. Mastering these regulations enables employees to optimize their retirement planning while maintaining EPF compliance throughout their careers. Strategic management of your EPF account, including timely transfers and well-planned withdrawals, significantly enhances long-term financial security and retirement readiness. Private PF trusts. Private PF trusts require exemption from the EPF scheme, must adhere to pension and EDLI schemes, and need EPFO approval to secure tax benefits. Trust requirements. Organizations establishing their own PF trusts must obtain exemption from the EPF scheme. This approval requires formal application prior to implementation. Companies must submit comprehensive trust documentation, detailed financial statements, and evidence of their capacity to manage funds responsibly. Scheme governance. Despite operating a private trust, employees remain covered under the pension and EDLI schemes. Contributions to these schemes continue to be mandatory. The trust must maintain separate, detailed records for these funds for each employee. Tax benefits. All private trusts require EPFO exemption to receive tax advantages. Without this official approval, contributions may not qualify for tax deductions. The trust must fully comply with Section 17 of the EPF Act to ensure employees receive Section 80C tax deductions. Compliance requirements. Private PF trusts must provide benefits that are at least equivalent to or superior to the EPF scheme, adhere to stringent investment guidelines, and submit comprehensive reports to the EPFO regularly. They must diversify investments across government securities, debt instruments, and equity to achieve an optimal balance between safety and returns. Administrative structure. The trust requires a balanced board comprising equal representation from employers and employees. This board must convene regularly, ensure decision-making transparency, and prioritize the protection of member interests. Inspection and monitoring. Private trusts undergo periodic scrutiny by EPFO officials to verify compliance with all regulations. Non-compliance can result in revocation of exemption status, substantial financial penalties, or legal proceedings against trustees. Interest rate management. Private PF trusts must guarantee interest rates that match or exceed those declared by the EPFO. The trust must demonstrate strong financial performance to sustain these interest rates without compromising members' funds. Transfer and portability. Private PF trusts must facilitate seamless account transfers when employees change employment. This ensures uninterrupted service credit and safeguards employees' benefits throughout their professional journey. Managing a private PF trust entails significant responsibilities but offers valuable advantages, including more flexible fund management and potentially enhanced returns for employees. Provided all regulatory requirements are meticulously observed, membership duration. EPF membership has no time restrictions and can continue beyond employment termination. Though accounts stop earning interest after 3 years without contributions, members permanently retain rights to their accumulated funds regardless of employment status. Lifetime membership. The Employees Provident Fund scheme offers unlimited membership duration, allowing you to maintain your account indefinitely. This flexibility distinguishes EPF from many other retirement plans with fixed terms, giving you greater control over your long-term financial planning. Post-employment continuity. Your EPF membership can remain active even after leaving your employer. This valuable feature preserves your PF account number and allows your retirement savings to grow continuously, regardless of career transitions. You may also make voluntary contributions to further build your retirement nest egg. Interest accrual limitation. Accounts with no contributions for 36 consecutive months cease earning interest after this 3-year period. Your principal amount and previously accumulated interest remain secure and available for withdrawal under applicable regulations. This policy encourages either regular contributions or timely benefit claims. Account restoration. Dormant accounts become active again when contributions resume, either through new employment or voluntary payments, restoring the interest-earning capability. Reactivation typically requires submitting current identification documents to your EPFO office, particularly if your personal information has changed. Seamless transfers. When changing employers, transferring your EPF account instead of withdrawing funds ensures uninterrupted membership and preserves all associated benefits. This process can be initiated online through the EPFO portal for greater convenience. Record maintenance. For smooth long-term membership management, regularly update your identity details including Aadhaar, PAN, bank account information, and nomination records. This proactive approach ensures efficient processing when you eventually transfer or claim your funds. International employee provisions. International workers are subject to specialized regulations regarding membership duration and continuity, particularly those from countries with social security agreements, SSAs, with India. These agreements may prevent dual contribution requirements or enable benefit integration across countries. Posthumous arrangements. Membership terminates upon a member's death, but the accumulated balance with interest transfers to the designated nominee or legal heir. The claim process requires specific documentation verifying the claimant's relationship to the deceased member. Employment gaps and membership. EPF membership continues during employment gaps, workplace closures, and strikes. Though non-working periods affect pension calculations, membership is exclusively for employees. Non-employment periods. Gaps between jobs don't terminate your EPF membership, but do impact your pension calculation under the employee's pension scheme. These intervals aren't counted toward your pension service period. Your accumulated savings remain secure, though gaps may reduce your final pension amount. Closures and strikes. Your membership remains active during workplace closures, lockouts, or strikes. Since no wages are paid during these periods, no contributions are made. However, your employment relationship is still considered intact, safeguarding your Social Security benefits throughout these disruptions. Employer membership. Employers cannot become EPF members. The scheme is exclusively for employees. While employers must contribute on behalf of their employees and comply with EPF regulations, they cannot participate as members themselves. Transfer during gaps. When changing jobs, you can't transfer your EPF account to your new employer even with an employment gap between positions. This maintains the continuity of your membership and savings. You can initiate transfers online through the EPFO portal or through your new employer's HR department. Voluntary contributions. During employment gaps, you may make voluntary contributions to your EPF account with approval from your local EPF office. These payments help maintain service continuity and potentially enhance your pension benefits. Contact your regional EPF office with appropriate documentation to arrange this. Documentation requirements. When claiming benefits after employment gaps, you may need to provide documentation explaining contribution interruptions. This could include resignation letters, new employment offers, self-declarations, or other evidence of your employment status during the gap period. Impact on Universal Account Number, UAN. Employment gaps don't affect your UAN status. It remains active and can link to future employment, providing seamless access to EPF services regardless of career breaks or job changes. Interest accrual during gaps. Your EPF balance continues earning interest for up to 3 years during employment gaps, even without new contributions. This helps your savings grow during periods of unemployment or career transitions, supporting your long-term financial security. Withdrawal provisions. During extended employment gaps, you can make partial withdrawals for specific needs such as housing, education, or medical emergencies without closing your account. This provides financial support during unemployment while preserving your EPF membership benefits. International employment gaps. If working abroad, special provisions allow you to maintain your EPF membership or transfer benefits under specific country agreements. Consult with EPFO regarding arrangements with your destination country before departing for international employment. Post-employment membership. EPF membership is available through employment in covered establishments. Specific rules govern continued membership, and special provisions exist for security personnel and smaller workplaces. Understanding these regulations ensures proper coverage and maximizes retirement benefits for eligible workers. EPF membership guidelines. Continued membership. After leaving employment, workers can maintain EPF membership through voluntary contributions. This preserves uninterrupted benefits and enables seamless fund transfers to new employers. Members can keep their accounts active for up to 36 months without new contributions. Employment requirement. Direct EPF enrollment without employment is not possible. You must work in an establishment covered under the EPF and MP Act 1952. Self-employed individuals are ineligible under current regulations, maintaining the employer-employee contribution framework. Security personnel. Security guards deployed across multiple locations receive EPF benefits through their primary employer, regardless of posting location. The main employer manages all contributions even when personnel work at various client sites. Small establishments. Workplaces with fewer than 20 employees can join EPF if the majority of workers and the employer consent under Section 1(4) of the Act. Once enrolled, the establishment remains covered even if employee numbers decrease. International workers. Foreign nationals employed in covered Indian establishments must participate in EPF unless exempted by bilateral agreements. These employees follow special regulations regarding withdrawals and may have different contribution rates. Membership transfer. When transitioning between covered establishments, members can transfer their EPF account to maintain service continuity. This process can be completed online using the Universal Account Number, UAN. Excluded employees. EPF eligibility excludes employees earning above Rs. 15,000 monthly at the time of joining, though they may opt in, and specific positions detailed in Schedule I of the EPF scheme, including apprentices. Retroactive membership. When an establishment newly registers with EPF, employees can receive membership backdated to their original joining date, provided proper employment records exist. Membership verification. Employees should regularly verify their EPF status through the UAN portal or their local EPF office to ensure contributions are correctly credited to their accounts. Additional benefits of EPF. EPF delivers comprehensive financial protection through pension, insurance, and savings mechanisms that safeguard employees throughout their working years and into retirement. Key EPF benefits include pension scheme. Employees earning up to Rs. 15,000 monthly receive pension benefits through the Employees Pension Scheme, EPS 1995. This provides regular monthly income after retirement, with amounts based on service duration and wages. Members contributing for at least 10 years qualify for pension at age 58. The scheme also includes disability and widow pensions, extending protection to the entire family. Insurance coverage. The Employees Deposit-Linked Insurance Scheme, EDLI, provides life insurance benefits of up to 7 rupees lakhs to family members if an employee dies during service. This coverage comes at no additional cost to employees, as employers contribute 0.5% of wages. Benefit amounts are calculated based on the average EPF account balance during the 12 months preceding death. Financial security. EPF functions as both a retirement fund and emergency savings vehicle, growing through employer contributions and compound interest. The current interest rate of 8.15%, 2023-24 exceeds many government savings options. Members can access these funds for housing, education, and medical emergencies. Over a typical career span of 30-35 years, even modest monthly contributions can accumulate into substantial retirement savings. Tax advantages. EPF contributions qualify for tax deductions under Section 80C, with annual contributions up to 1 rupee. 5 lakhs eligible for deduction. Interest earned is often tax-exempt, and withdrawals after 5 years of continuous service are completely tax-free, making EPF more advantageous than many alternative investment options. Withdrawal options. members can make partial withdrawals for specific needs such as housing, up to 36 months of salary contribution, medical treatment, up to 6 months salary for serious illnesses, marriage, or education without closing their account. Additionally, members can withdraw up to 90% of their savings when approaching retirement within 1 year. Universal Account Number, UAN. The UAN system has streamlined account management by enabling paperless transfers when changing employers. This permanent number follows members throughout their career, connecting all EPF accounts. Through the UAN portal and mobile app, members can monitor contributions, submit online claims, and update personal information effortlessly. International Worker Benefits. EPF maintains special provisions for international workers through bilateral agreements with numerous countries. These arrangements prevent double taxation, allow service period aggregation across countries, and facilitate benefit transfers to home countries. Workers from non-agreement countries can withdraw their EPF funds when permanently leaving India or upon retirement. COVID-19 support. During the pandemic, EPFO introduced emergency withdrawal provisions, allowing members to access up to 3 months' salary. Additionally, the government covered both employer and employee contributions, 24% of wages, for small businesses with up to 100 workers for 3 months, providing critical support during the crisis. Together, these benefits form a comprehensive safety net that protects employees throughout different life stages, establishing EPF as a cornerstone of India's social security framework. By fully understanding these benefits, members can maximize their financial security and develop more effective retirement strategies.
Pension scheme eligibility. The EPF pension scheme has specific eligibility criteria that govern participation, including restrictions for existing pensioners, employees joining near retirement age, and dormant accounts. Here are the essential eligibility guidelines for the employee pension scheme. EPS. Under EPF, current pensioners, individuals already receiving an EPS pension, can only participate in the Provident Fund, not re-enroll in the pension scheme. This prevents duplicate benefits, while allowing continued EPF contributions during pension receipt. Age restriction. Employees joining a company at age 58 are ineligible for the pension fund as they cannot fulfill the minimum contribution period before the retirement age of 60. However, they remain eligible for the Provident Fund. Dormant accounts. While funds can remain in your Provident Fund until withdrawal, accounts without contributions for over 3 years cease earning interest. After this period, it's advisable to transfer or withdraw funds from inactive accounts. Contribution requirements. Pension eligibility requires a minimum of 10 years, 120 months, of EPS contributions. Your pension amount correlates directly with your salary level and service duration, with higher contributions generally yielding enhanced pension benefits. International workers. Workers from countries with bilateral social security agreements with India benefit from special provisions. These agreements enable the combination of work periods across both countries for pension qualification. India maintains such agreements with approximately 20 nations, including Belgium, Germany, France, Switzerland, Canada, and Japan. Rejoining after withdrawal. If you resume employment after claiming withdrawal benefits, you must establish a new pension account with fresh contributions. Your previous service period is disregarded unless you reimburse the withdrawn amount with interest. Early pension option. You may opt to commence pension receipt at age 50 rather than 58. Though this reduces your benefits, each year of early retirement decreases your pension amount by approximately 3 to 4%. This provision accommodates those requiring pension income before standard retirement age. Higher pension option. Contributors based on salaries exceeding the standard ceiling may qualify for pension calculated on their actual wages under specific conditions, though requiring additional contributions. This results in enhanced pension benefits. Applications are subject to strict deadlines and verification processes. Disability provisions. Employees who become permanently disabled during employment qualify for disability pension regardless of contribution duration. Disability must be certified by an EPFO-approved medical board, with pension amount based on final salary. This provides crucial financial support for those unable to continue working due to disability. Comprehending these regulations is crucial for effective retirement planning and maximizing your EPF pension benefits. Regularly monitor your EPF account, maintain consistent contributions, and stay updated on regulatory changes that may impact your entitlements. Deceased members' PF distribution. When a member passes away, their Provident Fund is distributed according to nomination status and family circumstances. EPF follows specific protocols to ensure proper financial support reaches dependents and legal heirs. Distribution rules and procedures. With valid nomination, The PF amount is distributed as per the percentages specified by the member. EPFO transfers funds directly to nominees' bank accounts after verification. Nominees must submit Form 20 PF claim and Form 10D pension claim with their details. Without nomination, the PF amount is divided equally among family members, spouse, children, and dependent parents. They must apply together using one form with individual bank details and provide relationship proof. Additional documentation is required when multiple children are involved. No family members. Funds transfer to legal heirs as determined by succession or legal heir certificates. This process involves court proceedings and typically takes 3-6 months. Claimants must provide an indemnity bond with 2 guarantors. Pension nomination. If a pension member dies before receiving benefits and has no eligible family, the pension goes to their nominee. Applications must be submitted within 6 months of death, though late applications with valid explanations may be considered by the Commissioner. No nomination or family. Pension transfers to dependent parents, father first, then mother. Parents must submit an affidavit proving dependency on the deceased member, which EPFO may verify before payment. Minor nominees. Payments for minor beneficiaries go to their legal guardian with court certification, or into a joint account with the minor. Funds are typically placed in fixed deposits until the minor turns 18. Guardians must provide EPFO with annual statements showing proper fund utilization. Dispute resolution. The Regional PF Commissioner makes final decisions on distribution disputes, which can be appealed to the central government within 60 days. All claimants may present evidence, and process records are maintained for reference. Documentation requirements. Claimants need to submit death certificate, identity proof, relationship evidence, bank details, and claim forms 20, 5 if, and 10D. Additional requirements include a canceled check or bank passbook, Aadhaar card, photographs, and the deceased's employment details. For deaths within 5 years of leaving employment, a medical certificate may be necessary. Special cases. For members who die while employed, employers must initiate claims. If the deceased was receiving pension, family pension transfers to the eligible spouse upon submission of a death certificate and relationship proof. Deaths within 7 years of retirement receive enhanced benefits. Processing timeline. Standard claims are processed in 20 to 30 days, while complex cases may take up to 90 days. EPFO's auto settlement can expedite straightforward claims to 7 to 15 days. Claims from COVID-19 victims' families receive priority processing. Once all documents are submitted, the distribution process typically completes within 20 to 30 days. Family members can track claim status online through the EPFO portal, or by contacting the relevant office. EPFO maintains help desks at all regional offices to assist with claims and documentation. The EPFO call center, 1-800-118-005, provides status updates and guidance. Families should retain copies of all submitted documents and receipts. Nomination rules. EPF nomination rules are based on your marital status and should be updated when your family situation changes. These rules ensure your benefits reach the right people and provide financial security to your family in case of your untimely death. Unmarried members. If you're single, you can nominate anyone, including non-family members. This nomination remains valid until marriage, or until you change it. After marriage, submit a new nomination form within 90 days. After marriage, when you acquire a family through marriage, your previous nomination becomes invalid automatically. Benefits will transfer to your spouse and children. File a new nomination promptly after marriage. Family includes spouse, children, and dependent parents. Previous scheme members. If you didn't join the Family Pension Scheme of 1971, you can still opt for EPS 1995. Apply within 6 months of notification by paying the required amount with interest. Multiple nominees. You can designate several beneficiaries and specify the percentage each should receive. The total must equal 100%. If your allocation contains errors, EPFO will determine the distribution method. Minor nominees. When nominating someone under 18, you must appoint a guardian, other than yourself, to receive the funds until the minor reaches adulthood. The guardian must provide a written commitment to use the money for the minor's benefit. Updating nominations. You can modify your nomination anytime by submitting a new form. Review your nominations after major life events such as marriage, childbirth, or death in the family. Each new nomination supersedes all previous ones. Joint accounts. For joint EPF accounts, both account holders need to file separate nomination forms. Each person may nominate different individuals for their portion. Cancellation. You can cancel a nomination without immediately providing a new one, though it's advisable to submit new nomination details simultaneously to prevent complications. Submit all nominations on Form 2, revised, to your employer, who will forward it to the EPFO office. Keep a copy for your records. The nomination becomes effective only after it's recorded in the EPFO database, typically within 15 to 30 days. You can verify your nomination status on the EPFO member portal. Regular review and updates ensure your benefits reach your intended beneficiaries without delays. Pension calculation formula. Your EPF pension is determined by your years of service, average salary in your final years, and uses a standard divisor of 70. With maximum qualifying service, you can receive up to $7,500 monthly. The EPS formula incorporates these key components. Divisor, 70 the standard denominator in the pension calculation salary period, 60 months your average wages from the final 5 years maximum service, 35 years the highest number of working years, counted maximum pension, 7,500 the ceiling on monthly pension benefits wage ceiling, 15,000 the highest monthly salary considered for calculation minimum pension, 1,000 the guaranteed minimum monthly payment core formula, monthly pension equals, average salary x pensionable service, percent 70 calculating your pension, step by step determine your average monthly salary from the last 60 months, capped at 15,000, 1. Calculate your total pensionable service years, up to 35 years maximum. 2. Apply the formula, average salary x pensionable service, percent 703. Verify the result meets the minimum threshold of 1,0004. Note that 7,500 is the maximum monthly pension regardless of calculation results. 5. Sample calculations based on service length, assuming maximum pensionable salary, 15,000, 35 years of service, 15,000 x 35, percent 70 equals 7,500 monthly. 30 years of service, 15,000 x 30, percent 70 equals 6,428 monthly. 25 years of service, 15,000 x 25, percent 70 equals 5,357 monthly. 20 years of service, 15,000 x 20, percent 70 equals 4,285 monthly. 10 years of service, 15,000 x 10, percent 70 equals 2,142 monthly. Factors affecting your final pension. Several elements can influence your pension amount. Service interruptions, breaks in employment reduce your pensionable service period. Premature withdrawals, early EPS withdrawals diminish your final pension benefits. Extended service, employment beyond age 58 may enhance your pension amount. Wage fluctuations, variations in your final 5-year salary impact the calculation. Regulatory updates, government policy changes may modify pension calculations over time. Monitor your EPS account statements regularly to ensure your service period is accurately recorded. Discrepancies in your employment history can significantly reduce your pension benefits. Review your annual statement for accuracy. For a personalized projection, utilize the pension calculator available on the EPFO portal, or consult with your organization's HR department for guidance. Pension calculation example. Your monthly pension is calculated using salary x years, worked percent 70. The maximum pension is 7,500 for 35 years of service with 15,000 salary, the highest recognized amount. Key components in the calculation: pensionable salary, up to 15,000, maximum amount considered, service period, up to 35 years, maximum duration counted, standard divisor, 70, fixed value used in all calculations. Maximum pension, 7,500, highest possible monthly amount, minimum pension, 1,000, guaranteed base amount, contribution rate, 8.33% of salary, contributed by your employer. Step-by-step calculation guide. Determine your average monthly salary from the last 5 years, capped at 15,000. 1. Count your total years of eligible service, maximum 35 years. 2. Apply the formula, average salary x years of service, percent 703. For maximum benefits, 15,000 x 35, percent 70 equals 525,000, percent 70 equals 5,004. Verify your pension is at least 1,000 minimum guaranteed amount. 5. Add any applicable bonuses if you retired after age 586. Service period examples. How your pension varies with different service periods. At maximum salary, 25 years of service, 15,000 x 25, percent 70 equals 5,357. 30 years of service, 15,000 x 30, percent 70 equals 6,428. 20 years of service, 15,000 x 20, percent 70 equals 4,285. 15 years of service, 15,000 x 15, percent 70 equals 3,214. 10 years of service, 15,000 x 10, percent 70 equals 2,142. Salary variation examples. How your pension changes with different salary levels. With full service, 10,000 salary, 35 years service, 10,000 x 35, percent 70 equals 5,000 7,500 salary, 30 years service, 7,500 x 30% 70 equals 3,214 5,000 salary 25 years service, 5,000 x 25% 70 equals 1. 785 important considerations. These factors can impact your final pension amount. Service interruptions, non-contributing periods, aren't counted toward service years. Early retirement. Retiring before age 58 may reduce your benefits. Additional contributions. Higher voluntary contributions may enhance your pension. Insufficient service. Less than 10 years of service results in a lump sum payment. Instead, ideal scenario. If you join at age 23, contribute consistently based on 15,000 salary until age 58, 35 years, you'll receive the maximum monthly pension of 7,500. Note: actual pension amounts depend on your individual contribution history and prevailing regulations. Lower contributions result in proportionally lower pensions. Benefits begin immediately after your 58th birthday. Submit your application at least 3 months before retirement with all required documentation to prevent payment delays. Average salary determination. Your pension is calculated based on your average salary from the final 60 months of employment, excluding unpaid periods. This figure forms the cornerstone of your pension benefits. Here's how your average salary is determined. Last 60 months. We analyze your final 5 years, 60 months, of employment, typically capturing your peak earning period to provide a more favorable pension based on your career culmination. Excluding unpaid time. Periods without contributions, such as unpaid leave, are omitted from calculations. For instance, if you took 3 months of unpaid leave, we would consider only the remaining 57 months. Salary cap. Regardless of your actual earnings, pension calculations only recognize up to Rs 15,000 per month. Even if your monthly income reaches Rs 25,000, your pension calculation will be limited to the Rs 15,000 ceiling. Calculation method. We sum your eligible earnings throughout this period and divide by the number of contribution months. For example, total earnings of Rs 840,000 over 60 months would yield an average of Rs 14,000 monthly. Inflation adjustments. To maintain equity, earlier salaries within this period may be adjusted for inflation, ensuring fair representation of your earning history. Purpose. This average becomes your pensionable salary in the pension formula, designed to reflect your pre-retirement earning level. Benefit. This methodology honors your professional growth, ensuring your pension correlates with your career achievements rather than early career earnings. Required documentation. Preserve your salary certificates and contribution statements from this critical period to ensure precise calculations. Example calculation. Consider an employee with the following monthly salary progression in their final 5 years. Year 1. Rs 12,000 per month. Year 2. Rs 13,000 per month. Year 3. Rs 14,000 per month, including 2 months unpaid leave. Year 4. Rs 15,000 per month. Year 5. Rs 16,000 per month, capped at Rs 15,000. Calculation. Total counted months, 58 months, 60 minus 2 months of unpaid leave. 1. Total eligible earnings, Rs 794,002. Average monthly salary, Rs 794,000%. 58 equals Rs 13,689.663. Regular verification of your salary statements during your final 5 years is crucial. Even minor discrepancies in your records can substantially reduce your lifelong pension benefits. Conduct annual reviews of your pension contribution records to identify and rectify any errors promptly. Those with irregular employment or salary patterns should pay particular attention to this averaging period, as fluctuations can significantly impact your final pension amount. Scheme certificate benefits. A scheme certificate preserves your pension benefits when changing jobs and ensures family protection. This official document validates your membership and maintains your service record for accurate pension calculations. Key benefits of having a scheme certificate. Job transitions. Seamlessly transfer your pension account between employers while maintaining your service record and benefits, eliminating the need to withdraw and rejoin. Family security. Your dependents receive a family pension if you pass away, helping them maintain their standard of living. The benefit amount correlates with your total service period documented on the certificate. Enhanced ex-serviceman protection. Families of ex-servicemen receive pension benefits in addition to military pension, effective from 27/07/2001. Upon submitting both the certificate and military service documentation. Service continuity. Your entire contribution history counts toward your final pension, even with employment gaps, particularly valuable for contract and seasonal workers. Service consolidation. When joining a new covered employer, Your certificate enables combining previous service periods. Submit it within 3 months of your new employment to ensure proper crediting. Reduced bureaucracy. This single document verifies all previous pension contributions, significantly simplifying employer transitions and reducing paperwork requirements. Preserved withdrawal rights. Maintains your entitlement to withdrawal benefits should you decide against rejoining the scheme. With access based on your documented service period. Streamlined transfers. Facilitates smoother pension fund transfers between employers, minimizing delays, and ensuring continuous benefit availability. Official membership verification. Serves as recognized proof of scheme membership, which may be required for various financial transactions and services. Global recognition. Documents your pension contributions for potential recognition by countries with established social security agreements if you relocate internationally. Safeguard your scheme certificate carefully, for it represents your earned pension rights. Create multiple copies, store them in secure locations, and immediately report any loss to pension authorities. Periodically verify that certificate details accurately reflect your contribution history to ensure proper documentation of your service period.
Pension scheme exemption. Only entire workplaces, not individual employees, can be exempt from the pension scheme. Members can claim pension at age 58, with early options available from age 50. Importantly, exempted establishments must provide benefits, at least equivalent to the standard scheme. Individual exemption. Individual workers cannot opt out of the pension scheme. All employees in an establishment must be covered under the same pension plan. This ensures equitable benefits and maintains the scheme's financial integrity. Establishment exemption. Only entire establishments can apply for exemption from the pension scheme. They must demonstrate that their private pension plan meets or exceeds the standard scheme's benefits. Applications require comprehensive plan documentation and financial verification. Pension eligibility age. Members become eligible for full pension benefits at age 58. Those leaving employment between ages 50-57 can access early pension benefits, with proportionate reductions. This graduated approach balances fund sustainability with flexibility for early retirees. Exemption requirements. Establishments seeking exemption must establish a dedicated pension fund with proper governance and adhere to regulatory investment guidelines. Requirements include forming a trustee board with employee representation and submitting to regular financial audits. Benefit equivalence. An establishment's private pension plan must deliver benefits, at least equal to those offered by the standard pension scheme. This includes comparable retirement benefits, disability coverage, and survivor pensions for dependents. Withdrawal benefits. Employees in exempted establishments retain portability rights for their pension benefits when changing employment. This safeguards their accumulated pension capital and service credits during career transitions. Compliance obligations. Exempted establishments must maintain comprehensive documentation, submit periodic reports, and facilitate inspections of their pension operations. Non-compliance may result in exemption revocation. Regulatory oversight. Exempted establishments remain subject to regulatory supervision to ensure ongoing compliance. Authorities may conduct unannounced inspections, request additional documentation, or mandate remedial actions for identified deficiencies. Exemption cancellation. Exemptions may be revoked if establishments fail to maintain benefit standards, mismanage pension funds, or violate regulatory requirements. Upon cancellation, all accumulated funds must be transferred to the standard scheme. Establishments considering exemption should carefully evaluate the administrative requirements, financial implications, and ongoing responsibilities before proceeding with an application. Consultation with pension specialists and legal advisors is highly recommended to navigate the complex regulatory framework governing pension scheme exemptions. Death benefits under pension scheme. Family pension begins after just 1 month of membership, providing immediate financial security. Benefits transfer seamlessly to spouse and children, with lifelong support for disabled dependents. Even when employers default on contributions, families receive full pension benefits. This comprehensive protection ensures financial stability for bereaved families during their most vulnerable time. Immediate eligibility. Family pension activates after just 1 month of contribution, ensuring financial protection from the earliest stages of membership. This progressive feature stands in contrast to conventional plans requiring years of service, offering crucial support when families face unexpected loss. Streamlined succession. Upon a member's death, pension transfers automatically to the spouse, with children receiving benefits until age 25. 2 children simultaneously. This seamless transition eliminates bureaucratic delays during a period of grief, establishing clear inheritance guidelines that prevent disputes, lifetime support for disabled dependents. Disabled children receive pension benefits for life, independent of the standard two-child pension allowance. This compassionate provision ensures perpetual financial stability for vulnerable family members who require specialized care and ongoing support. Guaranteed benefits despite employer default. If employers fail to make mandatory contributions, the scheme still guarantees full pension benefits to families. This robust safeguard exceeds protections offered by private pension plans, ensuring families never bear the consequences of employer negligence. Simplified claims process. Claiming death benefits requires only essential documentation, a death certificate, relationship proof, and a completed form. This streamlined process minimizes administrative burden during bereavement, with local offices providing personalized assistance to families navigating paperwork requirements. Equitable benefit structure. Death benefits are calculated based on the member's salary history and service duration, with guaranteed minimum payments. The formula provides enhanced benefits for members with multiple dependents, acknowledging the greater financial needs of larger families after losing their primary income earner. Complete retroactive coverage. Benefits can be claimed retroactively to the date of death, ensuring families receive their full entitlement regardless of when they apply. This policy prevents financial penalties for families who may be unaware of benefits or unable to file claims immediately after their loss. These comprehensive death benefits demonstrate the scheme's unwavering commitment to authentic Social Security. Families receive substantial and meaningful financial protection following the loss of a pension scheme member, regardless of contribution duration. By prioritizing family welfare during periods of vulnerability, the plan delivers equitable support to beneficiaries across all socioeconomic backgrounds. Pension nationwide availability. Access your pension seamlessly anywhere in India. Your benefits combine service from all employers throughout your career. This provides complete geographic flexibility and work history recognition for retirees. Nationwide access. Receive your pension anywhere in India, regardless of where you worked or contributed. This freedom allows you to retire in your hometown, move closer to family, or relocate to any preferred location without disrupting your benefits. Your pension follows you through any designated bank in the national network. Service consolidation. Your pension calculation includes all service periods across different employers throughout your career. This comprehensive approach ensures workers with diverse employment histories receive full recognition for their total contributions. The system automatically aggregates your complete work record for maximum benefit calculation. Seamless transfer. Relocating between states requires no pension account transfers or administrative hurdles. The centralized database maintains your complete record, eliminating paperwork when you move. This feature particularly benefits migrant workers who contributed while working in industrial centers but wish to retire in their native villages. Universal recognition. Every pension office provides identical services and recognition of your benefits, eliminating regional disparities. Whether in metropolitan cities or remote districts, members receive consistent service standards and equal treatment. The standardized system ensures fairness regardless of geographic location. Digital accessibility. The comprehensive online portal provides 24/7 access to pension services from any internet-connected location. Check payment status, download statements, submit annual life certificates, and update personal information without visiting physical offices. This digital infrastructure especially benefits elderly members with mobility challenges or those in remote areas. Documentation flexibility. Submit required documents at any regional pension office nationwide, regardless of your original registration location. This decentralized approach accelerates verification processes and eliminates unnecessary travel. Members can utilize whichever office is most convenient, streamlining administrative requirements. Unified grievance system. Address concerns through a standardized complaint resolution system accessible from anywhere in the country. The national helpline and online portal follow consistent protocols with guaranteed response timeframes, ensuring all pensioners receive equal attention, regardless of location. Cross-state banking integration. The extensive banking network spans all Indian states and territories, ensuring uninterrupted pension disbursements nationwide. This robust financial infrastructure supports direct deposits to any Indian bank account, automatic transfers, and multiple withdrawal options to accommodate all retirees' preferences. This nationwide accessibility demonstrates the scheme's commitment to member convenience and financial security. By eliminating geographic barriers, the pension system serves India's increasingly mobile workforce while maintaining consistent service quality throughout the entire country. Pension amount stability. Your pension amount remains fixed once established, with no annual increases to adjust for inflation. Early pension decisions are permanent and cannot be revised later, making thorough long-term financial planning essential. Fixed payment structure. Unlike some government pensions that adjust for inflation, your pension amount remains unchanged after it's established. This fixed income requires strategic financial planning to account for the diminishing purchasing power over time as living costs increase. Irreversible early pension. Choosing a reduced pension at age 50 is a permanent decision. You cannot upgrade to the full pension upon reaching 58, even if your financial circumstances change significantly. This irreversibility demands careful consideration of your long-term financial needs before opting for early benefits. Critical start date. Early pension applications require selecting a specific commencement date. Without your selection, the system defaults to your application submission date. This date significantly impacts your lifetime pension amount, so choose strategically based on your tax situation and other income sources. Unalterable calculations. Once the EPFO approves your pension calculation, it becomes permanent. Thoroughly verify all service records and wage details before applying, as even calculation errors may remain uncorrected throughout your entire pension period if not promptly reported. Document precision. The accuracy of your submitted documents directly determines your pension amount. Errors or incomplete records can permanently reduce your benefits with no opportunity for future correction. Maintain comprehensive employment records throughout your career to ensure accurate pension calculations. Standardized formula. Your pension is calculated using a fixed formula based solely on service duration and wages. This standardized approach disregards market conditions, investment performance, or personal financial circumstances, resulting in consistent calculations across all pensioners. Immunity to policy changes. New pension regulations implemented after your pension commencement won't affect your benefits. Even if more favorable terms are introduced later, you'll continue receiving benefits according to the rules in effect when your pension began. Restricted account changes. Redirecting your pension to a different bank account involves substantial paperwork and potential delays. Select a reliable, accessible bank for receiving your pension initially to minimize payment disruptions throughout retirement. Healthcare cost planning. With a fixed pension amount throughout retirement, strategic planning for healthcare expenses becomes crucial as these costs typically escalate with age. Consider supplementary savings or insurance coverage to bridge the widening gap between your fixed income and rising expenses over your retirement years. Pension during employment. You can continue working after age 58 while receiving your pension. If you chose early pension, you may work but cannot rejoin the pension scheme. Your pension cannot be exchanged for a lump sum payment. Understanding these rules helps you plan your retirement more effectively. Key rules about working while receiving pension. Working after age 58. You can't continue employment beyond age 58 while receiving pension benefits simultaneously. Your pension calculation is based on contributions up to age 58, regardless of how long you continue working. This arrangement provides additional income during your later years and allows for a gradual transition to retirement. Submit your age-proof documents promptly to ensure timely pension payments. 1. Early pension considerations. If you opted for early pension, you may continue working but cannot rejoin the pension scheme. Even if your new employer participates in EPS, you remain on your existing pension plan. This decision is irreversible, so evaluate it carefully. Consider your long-term financial requirements before choosing early pension. 2. Employer contributions. While working and receiving pension, your employer's 8.33% contribution goes to your EPF account rather than your pension fund. This means your provident fund grows while your pension amount remains fixed. You can access these additional savings according to EPF regulations, providing supplementary retirement funds alongside your pension. 3. No lump sum conversion. The pension scheme does not allow you to surrender your monthly pension for a one-time payment. It's designed to provide regular monthly income throughout retirement, rather than a single large payout that might be depleted quickly. Financial experts recommend maintaining diverse investments for major expenses. 4. Pension during re-employment. Your monthly pension continues uninterrupted even if you start a new job. Pension payments don't cease when you work after age 58. This provision helps older workers maximize their income. Remember to plan for tax implications when receiving multiple income streams. 5. Multiple employment. If you work for multiple employers while receiving pension, all employer contributions, 8.33%, are directed to EPF rather than increasing your pension. These combined contributions can accumulate significant savings for additional financial security. Ensure all your employment is properly registered with EPFO. 6. Additional benefits. Working while receiving pension does not affect other retirement benefits such as gratuity or leave encashment. Each benefit operates under independent rules, separate from your pension status. This allows you to maximize each benefit. 7. International employment. If you work overseas, after commencing your pension, you can continue receiving payments in India, or have them transferred to your foreign bank account by following the appropriate procedures. Be mindful of currency conversion regulations and complete the necessary EPFO documentation before relocating abroad. 8. Understanding these regulations helps you make informed decisions about post-retirement employment and income planning. Consider consulting financial advisors and EPFO representatives to develop a strategy that optimizes both your pension benefits and employment opportunities. Stay informed about policy changes, as pension regulations may evolve over time. Pension and PF withdrawal members can withdraw their Provident Fund PF money while preserving pension benefits by obtaining a scheme certificate. Members have several options regarding their PF and pension funds. Separate withdrawals. You can withdraw your PF amount without withdrawing your pension benefits. By obtaining a scheme certificate, you can access your PF funds while preserving your future pension entitlements. This provides financial flexibility during transitional periods without compromising retirement security. Scheme certificate advantages. The scheme certificate preserves your pension service record and combines it with future service when you rejoin a covered establishment. This ensures continuity of pension benefits despite employment gaps or career transitions. Eligibility criteria. If you have accumulated less than 10 years of service and leave your employment, you can secure a scheme certificate to protect your pension rights. This is particularly valuable for professionals who change jobs frequently or take career breaks. Strategic financial planning. This option enables you to utilize your PF funds for immediate financial needs while safeguarding your pension for retirement. It represents an effective balance between addressing current financial requirements and ensuring long-term retirement security. Application process. Submit your application for a scheme certificate using Form 10C within 6 months of employment cessation. The certificate documents your service period and wage history for final pension calculation. Applications can be submitted online through the EPFO portal or in person at an EPFO office. Taxation considerations. While PF withdrawals may have tax implications in certain scenarios, maintaining your pension through a scheme certificate has no immediate tax consequences. Note that PF withdrawals before completing 5 years of service are taxable, while those after 5 years are tax-exempt. Procedure when rejoining. Upon joining another covered establishment with a scheme certificate, submit the certificate to your new employer. This ensures your previous service period is factored into your cumulative pension calculation. Verification procedures. The EPFO verifies the service period documented in your scheme certificate against previous employment records. Maintain copies of your employment documentation to facilitate this verification process. Impact on retirement benefits. Preserving service periods through scheme certificate significantly impacts your final pension amount. Each additional year of documented service enhances your monthly pension payments during retirement. Flexible alternative. The scheme certificate represents a middle ground option between completely exiting the pension scheme and remaining fully enrolled. It offers flexibility while safeguarding your retirement benefits. Making informed decisions about fund withdrawals can substantially impact your long-term financial well-being. Before finalizing any decisions, consult with EPFO representatives or qualified financial advisors to understand the full implications of your choices for both immediate needs and retirement planning. Date of birth correction. Members can correct birth dates with proper documentation. Children under 25 remain eligible for family pension regardless of marital status, and pension distribution follows specific rules for multiple legal spouses. Date of birth changes. Members can update their date of birth with proper documentation according to the change of date of birth for EPF and EPS members guidelines, March 4, 2020. Required documents include original birth certificates, school leaving certificates, or government-issued identification. Processing typically takes 15 to 30 days after verification. Members are allowed one change during their membership unless regional officers approve exceptional circumstances. Changes affecting pension eligibility undergo additional scrutiny. Children's pension rights. Children under 25 qualify for family pension upon a member's death, regardless of marital status. This equitable policy ensures fair treatment across gender and marital boundaries. Claimants must provide relationship and age verification. Pension amounts are calculated based on the member's contribution history and service duration. Children with disabilities may receive lifetime family pension with valid certification from authorized medical professionals. Multiple spouse benefits. When a member has multiple legal marriages, family pension is awarded to the first wife, based on marriage date. Upon her death, benefits transfer to the next surviving widow. All widows must submit marriage certificates and identification proof. Once established, the pension distribution cannot be altered, even with mutual consent among widows. If the primary widow fails to claim within 1 year, the next eligible widow may receive temporary benefits, subject to adjustment if the primary widow claims later. Documentation requirements. All claims require proper documentation including identity proof, relationship verification, and banking information. Documents must be self-attested with originals verified by authorized personnel. Incomplete documentation may result in delays or claim rejection. Foreign nationals require additional documentation including valid visas and certified documents from their country of origin. Digitally signed documents are now accepted through platforms like DigiLocker, reducing paperwork burden. Appeals procedure. If your birth date correction or family pension claim is denied, you may appeal to the regional EPFO office within 90 days, include all supporting evidence, and clearly state the grounds for reconsideration. Subsequent appeals may be directed to the Central Government Industrial Tribunal, which typically renders decisions within 6 months. Tribunal decisions are binding unless challenged in High Court within specified legal timeframes. Timing considerations. Submit birth date correction requests while actively employed or within 5 years of employment termination. Changes significantly affecting pension calculations require additional verification and may take longer to process. Members approaching retirement should verify their recorded birth date at least 1 year before planned retirement to allow sufficient time for corrections. Benefit implications. Birth date modifications can significantly impact pension eligibility and benefits. Adjusting to an earlier date may accelerate pension eligibility but potentially reduce benefits due to shortened contribution periods. Conversely, adjusting to a later date may delay pension commencement but potentially increase benefit amounts. Consider consulting a financial advisor before requesting significant birth date changes to understand the full impact on retirement benefits. Family pension nomination. Family pension follows a specific hierarchy based on the member's status, with distinct rules before and after pension commencement. Understanding these guidelines ensures eligible family members receive their entitled benefits. Key rules governing family pension nomination. No family members. If a member dies before pension commencement and has no family benefits transferred to their nominee, nominees must submit identification and relationship documentation within 90 days of the member's death to claim benefits. No valid nomination. Without a nomination, pension transfers first to the dependent father, then to the dependent mother. Parents must provide income verification and evidence of financial dependency. If both parents are deceased, benefits may be distributed based on court-issued succession certificates. After pension commencement, once a member begins receiving pension, nominations become void. Benefits automatically transfer to eligible family members according to established succession order. This transition typically requires 30 to 45 days after submission of death certificate and claim forms, along with identity verification and banking details. Family definition. Family encompasses spouse, minor children, and unmarried divorced widow daughters. Parents are excluded from the family definition for pension purposes, but may receive benefits under exceptional circumstances. Children with disabilities certified by medical authorities may receive lifetime benefits if the disability occurred before age 25. Legally adopted children hold equal rights as biological children. Nomination requirements. Nominations must be submitted via Form 2 to the EPFO office. Members should update nominations every 5 years or following significant life events. The EPFO now accepts online nominations, which process more efficiently than paper submissions. Exceptional circumstances. For missing members, families may claim pension after a 7-year waiting period with appropriate police documentation. For mentally incapacitated members, court-appointed guardians may manage claims. International workers may be subject to different regulations. Legal conflicts. When multiple claimants contest the pension, payments may be suspended pending court resolution. The EPFO adheres to court directives for benefit distribution. Proactively obtaining succession certificates can prevent delays. Taxation. Family pension may be subject to taxation under prevailing tax laws. Beneficiaries should consult tax professionals regarding exemptions and filing obligations. Tax may be deducted at source for pension amounts exceeding specified thresholds. Members should maintain current nomination records, particularly following marriage, childbirth, or nominee death to facilitate smooth benefit processing. The EPFO conducts regular campaigns enabling members to review and update nominations. The unified portal now allows online submission and tracking of nomination changes, streamlining the process considerably.
Unemployment impact on pension service breaks due to unemployment do not contribute to pensionable service. Spouses are mandatory beneficiaries for family pension. In the absence of family members or nominees, dependent parents become eligible pension recipients. Here's how periods of unemployment affect your pension benefits. Service calculation. Unemployment periods are not counted toward pensionable service. Benefits accrue only during active contribution periods. Employment gaps directly reduce your total qualifying service period. Contribution history. extended unemployment creates significant gaps in your contribution record. This diminishes your final pension amount and may delay eligibility for full benefits. Each non-contributory month proportionally reduces your retirement income. Eligibility threshold. A minimum of 10 years of contributions is required to qualify for pension benefits. Frequent or prolonged unemployment makes achieving this threshold more challenging, especially for those with intermittent employment history. Mandatory spousal coverage. Your spouse cannot be excluded from family pension entitlements. They automatically receive benefits, unless legally divorced. This provision ensures financial security for your spouse after your demise, regardless of separation status short of legal divorce. Contingency beneficiaries. In the absence of eligible family members, immediate family created through marriage, and designated nominees, dependent parents become the default pension recipients. They must substantiate financial dependency through income certificates and supporting documentation. Re-employment provisions. Resuming employment after a period of unemployment allows you to continue accumulating pension benefits. Previously earned service credit remains valid. However, retroactive contributions for unemployment periods are not permitted. Exceptional considerations. Members with substantial cumulative service across multiple employers despite unemployment gaps may petition the Central Board for special consideration. Such cases may be reviewed on humanitarian grounds. Interim financial options. During prolonged unemployment, scheme certificates or withdrawal benefits may seem attractive, but significantly compromise long-term pension security. Carefully weigh immediate financial needs against future retirement stability. Documentation requirements. Re-entering the workforce after unemployment necessitates proper documentation linking previous service to current employment. This includes comprehensive service certificates and previous PF account details. Pension calculation impact. Final pension benefits are calculated based on salary and total service duration. Unemployment-related service gaps directly reduce your qualifying service period, resulting in proportionally reduced monthly pension payments. Maintain comprehensive records of all employment periods to ensure accurate calculation of pension benefits upon retirement. Before making decisions with potential long-term implications for your pension, particularly during career transitions or extended unemployment, consultation with pension authorities is highly recommended. Disablement pension eligibility. EPS 95 members who become permanently disabled while employed may qualify for pension benefits regardless of age or service length, provided they have proper medical certification and meet all required criteria. Key requirements for disablement pension under the Employees Pension Scheme, 1995. Permanent disability. Members with full and permanent disabilities acquired during employment qualify regardless of age or service length. This applies to disabilities preventing any gainful employment. Medical examination. You must undergo an assessment by Central Board-approved EPFO doctors to verify you're permanently unfit for your occupation. Certification. Your medical certificate must confirm the disability occurred during employment and renders you unable to continue working. The certificate should clearly describe your condition with comprehensive supporting documentation. Active membership. You must have been an active EPS contributor when the disability occurred. Lapsed memberships may require additional verification. Application process. Submit disablement pension claims within 1 year of medical certification using Form 10D, including all relevant medical reports and employment details. Pension calculation. Your benefit amount is calculated based on salary and service period, with a guaranteed minimum amount established by the scheme. Financial protection. This benefit serves as crucial financial support for members who can no longer work, providing security for both you and your dependents. Ongoing verification. Periodic medical reassessments may be required to confirm your continued disability status, particularly in cases where improvement might be possible. Disablement pension provides essential financial protection when disabilities unexpectedly end your earning capacity. Additional important information about EPS 95 disablement pension. Disability definition. Under this scheme, disability refers to any condition preventing substantial gainful activity due to physical or mental impairment expected to last at least 12 months or result in death. Covered conditions. The scheme encompasses various physical and mental disabilities, including mobility impairments, sensory losses, vision hearing, and chronic conditions preventing employment. Retroactive payments. With proper documentation, you may receive payments backdated to disability onset, even with delayed applications. Benefit coordination. Understand how this pension interacts with other benefits, as disablement pension receipt may affect eligibility for certain other programs. Appeal rights. If your application is rejected, You have 90 days to appeal the decision. Include supplementary medical evidence to strengthen your case. Family provisions. If you die while receiving disablement pension, eligible family members can transition to family pension benefits. Steps to apply for disablement pension. Obtain comprehensive medical documentation from recognized healthcare providers. 1. Gather employment records demonstrating active contribution status at disability onset. 2. Complete Form 10D accurately and thoroughly. 3. Submit your application package to your regional EPFO office. 4. Attend all EPFO scheduled medical examinations. 5. Monitor your application status regularly. 6. If necessary, secure additional medical opinions to support potential appeals. 7. The disablement pension represents a critical financial safety net, acknowledging that disability can strike at any time and abruptly end earning capacity. This benefit helps preserve dignity and maintain quality of life when you would otherwise face severe financial hardship. Pension Benefit Differences. EPS 1995 provides varying pension amounts based on beneficiary status. Members receive full benefits. Widows receive either 50% if spouse was already pensioned or 75% if spouse died while employed. The Employees Pension Scheme, EPS 1995, offers tiered benefits tailored to different beneficiaries and their circumstances, ensuring financial security after retirement or death. Member Pension. 100% of calculated pension available to members who have contributed to the scheme and reached age 58 with at least 10 years of service. Calculated using the formula pensionable salary x service period %70. Members can opt for early pension at 50 with reduced benefits, or delay beyond 58 for enhanced benefits. Widow of pensioner. 50% of members' pension payable to the spouse after a pensioner's death, continuing until remarriage or death. The reduced amount reflects adjusted household expenses. This benefit activates automatically upon submission of the death certificate. Widow of non-pensioner. 75% of potential pension. A higher benefit for widows whose spouses died during employment. This increased amount helps families manage unexpected income loss and applies even without completed minimum service requirements. Orphan pension. 37.5% of pension amount provided to dependent children under 25 who have lost one or both parents. When both parents were EPS members, the higher pension amount applies. For children with disabilities, benefits may continue beyond age 25 if the disability occurred earlier. Multiple eligible children share the pension equally. Dependent parent pension. Available when the member was unmarried and childless, typically equaling 50% of the member's potential pension. Both parents receive equal shares when alive. The surviving parent receives the full amount if one dies. Return of capital option. Members may choose a slightly reduced monthly pension to ensure their nominee receives a lump sum after their death. This option must be selected at pension commencement. Commutation benefits. Pensioners can withdraw up to 1/3 of their pension as a lump sum, calculated based on age. The full pension is restored after 15 years without repayment requirement. Minimum pension guarantees. The EPFO ensures all beneficiaries receive at least the minimum monthly pension, currently $1,000 regardless of calculated amount. This minimum is periodically adjusted for inflation. EPS 1995 pensions are needs-based rather than strictly contribution-based. A pensioner's widow receives 50%, because the household was already adjusted to retirement income. A non-pensioner's widow receives 75% to address unexpected financial disruption and dependent needs. All recipients are guaranteed at least the EPFO established minimum pension, which undergoes regular inflation reviews. Pension calculations incorporate both salary and service duration using the established EPS 1995 formula. To claim benefits, applicants must submit identification proof, relationship documentation, death certificates, when applicable, bank details for direct transfers, and completed forms. Processing typically requires 20 to 30 days, following complete documentation. Annual life certificate submission is mandatory for continued benefit receipt. For international workers or NRI pensioners, special provisions exist for overseas pension transfers, subject to foreign exchange regulations and bilateral agreements between India and respective countries. Widow pension eligibility. Widows receive pensions regardless of when marriage occurred, continuing until remarriage or death. Upon remarriage, children's benefits convert to orphan pension status. Post-retirement marriage, widows qualify for family pension, even if marriage occurred after their spouse's retirement. This includes marriages without formal registration when sufficient proof exists, such as joint bank accounts or family statements. The EPFO recognizes both traditional and civil marriages as valid. Remarriage impact: a widow's pension ceases immediately upon remarriage. Children's pension then converts to orphan pension, 75% of the widow pension rate. Widows must notify the pension office within 30 days of remarriage to avoid potential repayment with interest. Some courts have granted exceptions in cases of genuine hardship when reporting was delayed. Duration of payment: pension continues until the widow's remarriage or death. Annual life certificates are required and can now be submitted electronically through the Jeevan Praman portal. Widows residing abroad may submit certificates approved by Indian embassies. Documentation requirements: required documents include death certificate, marriage proof, bank details, and identification documents. Additional requirements may include service records, pay certificates, photographs, and banking information. Many EPFO offices now process applications within 30 days. Multiple widows: when a member had multiple legal wives, the pension is divided equally among them, with each widow required to establish the legality of her marriage. Children from all marriages are ranked chronologically by birth date for pension eligibility. Court rulings regarding pension distribution supersede general guidelines. Minimum guaranteed period: if a widow passes away shortly after beginning to receive benefits, pension payments continue to legal heirs for at least 7 years, where scheme rules permit. This provision supports family members who relied on this income. Payment may be disbursed as a lump sum or according to succession laws. Taxation considerations: family pension is classified as taxable income based on applicable tax brackets. Section 80DD provides tax benefits for widows caring for disabled dependents. Widows whose sole income is pension may qualify for tax relief under Section 87A if their earnings fall below specified thresholds. Arrears of pension: when approval delays occur, back payments are calculated from the day following the member's death and paid as a lump sum with interest. Delays exceeding 1 year receive expedited processing. Transfer of pension rights: widows may transfer their pension account to any bank branch in India by submitting Form 14 to the new branch. Online transfer requests are typically processed within 15 working days. Legal recourse for denied claims: if a claim is rejected, widows can appeal through a 3-tier system, first to the Regional EPFO Committee, then to the Central Appellate Authority, and finally to the EPFO Appellate Tribunal. Complementary legal assistance is available for widows facing financial hardship. To ensure smooth processing, widows should present all required documentation at their nearest pension office. Maintaining updated personal information prevents payment interruptions. The EPFO provides dedicated support through their helpline, 1800 to 2208-555. With staff specially trained to assist widows during this challenging period. Children's pension eligibility: children's pension is prioritized by birth date regardless of parents' marriage status, requires a dedicated bank account, and must be collected from the same location as the widow's pension. Multiple marriages: children from all marriages are ranked solely by birth date. The 2 eldest children under 25 receive pension benefits regardless of which marriage they were born from, ensuring equitable treatment. Pension offices maintain comprehensive records of all eligible children to facilitate fair benefit distribution. Age limitations: benefits continue until age 25 for children pursuing education or vocational training. Children with disabilities may receive lifetime benefits if the disability occurred before age 25 and prevent self-support. Annual verification of educational enrollment or disability status is mandatory for continued benefit eligibility. Banking requirements: child pension payments must be deposited into a separate bank account. Guardians administer this account until the child reaches adulthood, after which the child assumes control. The account must be registered in the child's name with guardian access rights until majority age. Distribution location: widows and children must receive pension payments from the identical bank branch. Requests to change payment locations must be submitted jointly for all family beneficiaries. This policy streamlines administration and facilitates eligibility verification for pension authorities. Documentation: annual verification through educational certificates or disability assessments is required to maintain pension eligibility. Failure to submit timely documentation may result in temporary benefit suspension. All verification documents must be submitted at least 30 days prior to the annual pension anniversary. Orphan children: upon the death of both parents or the remarriage of the surviving parent, the child pension increases to 75% of the widow pension rate per eligible child. This enhanced benefit addresses the additional financial challenges faced by children without parental support. Guardian changes: if the primary guardian becomes unable to manage the child's pension, a formal application for guardian reassignment must be submitted with appropriate legal documentation. Pension authorities will review such requests within a 45-day timeframe. Taxation. Children's pension benefits generally remain tax-exempt until age 18. Beyond this age, standard tax regulations apply based on the recipient's total income. Students in higher education may qualify for additional tax exemptions under specific provisions. International beneficiaries. Children residing abroad must provide supplementary verification through recognized international agencies or Indian diplomatic missions. Special arrangements for international fund transfers can be established with prior authorization from pension authorities. Guardians should maintain consistent communication with pension offices to ensure continuous compliance with requirements and uninterrupted benefit payments. Specific inquiries should be directed to the regional pension office administering the benefits. Scheme certificate eligibility. Scheme certificates safeguard your pension rights during job transitions, mandatory for extended service periods, and optional for shorter employment. These certificates ensure your pension benefits remain intact regardless of career changes. Mandatory issuance. Required for employees with 10+ years of service who are under 58 years of age. This preserves your pension rights when leaving employment, guaranteeing continued eligibility for benefits regardless of future work status. Optional issuance. Available for those with less than 10 years of service. These certificates allow you to retain partial benefits even from shorter employment periods, particularly beneficial for frequent job changers. Service continuity maintains uninterrupted pension service record. Despite employment gaps, you remain eligible for benefits when switching employers or during unemployment periods. At retirement, multiple certificates can be consolidated to reflect your comprehensive work history. Application process. Submit Form 10C to your regional EPFO office within 6 months of employment termination. Required documentation includes service records and your Aadhaar card. Applications filed late may be considered with valid justification and applicable late fees. Certificate validity. Certificates remain effective until you reach retirement age, 58 years. Present them when applying for your final pension benefits. Their permanent validity eliminates the need for renewal, providing a lasting record of your pension entitlements. Benefit calculation. Your final pension amount incorporates all service periods documented on your certificates. This ensures credit for your cumulative service across multiple employers. Each certificate contributes to your final pension based on employment duration and earnings history. International portability. These certificates facilitate pension right establishment under bilateral Social Security agreements. This proves invaluable if you work internationally, while maintaining pension benefits in countries having reciprocal arrangements with India. Surrender option. You may surrender certificates for a lump sum payment before retirement age if you permanently relocate abroad, become incapacitated, or meet other qualifying conditions under paragraph 14 of the EPS scheme. Digital certificates. EPFO now provides digital certificates through its member portal. This eliminates paper documentation requirements and simplifies pension record management. Digital certificates incorporate robust security features to prevent fraudulent activities. Multiple pension limitations. EPS 1995 permits only one pension per service period, requires annual life verification, and offers multiple submission locations for these verifications. Understanding these regulations ensures uninterrupted pension disbursements. Single pension rule. You or your family members are entitled to only one pension for each service period under the Employees Pension Scheme 1995. This regulation applies even when contributions were made to multiple establishments during the same timeframe. If you qualify for multiple pensions, you have the right to select the most beneficial option. Failure to disclose existing pension benefits may result in recovery of excess payments with applicable interest. Your pension amount is calculated based on your cumulative service across all covered establishments. Employment gaps shorter than 6 months between consecutive jobs are typically disregarded when calculating total service. For service in both exempt and non-exempt establishments, a separate application is required to consolidate your benefits. Specific provisions apply if you've contributed to both EPS and other government pension schemes. Life certificate requirement. All pensioners must submit life verification once every 12 months following pension approval or previous certificate submission. Verification can be completed in person or digitally via Jeevan Praman using Aadhaar authentication. Non-submission may result in temporary suspension of pension disbursements. Submitting your certificate within 6 months of payment suspension ensures recovery of all withheld payments. Alternative arrangements exist for pensioners with disabilities and those residing overseas. While the primary submission window is November 1st 30 annually, certificates are accepted throughout the year. Pensioners with severe disabilities or terminal illnesses may apply for extended certificate validity. Legal guardians must provide additional documentation when submitting on behalf of pensioners unable to appear personally. Alternative biometric verification methods are available when facial recognition is unsuccessful. Submission locations: digital life certificates can be generated at nationwide common service centers. Pension disbursing banks operate dedicated counters during November for certificate submission. Post offices provide complimentary life certificate services. EPFO offices have designated staff trained to resolve technical difficulties. The Jeevan Praman mobile application enables remote submission via smartphone. Select banks offer home visitation services for pensioners aged 80+ by prior appointment. Indian diplomatic missions assist overseas pensioners with special drives conducted in November. Authorized medical practitioners can facilitate verification for pensioners with mobility limitations. Gram Panchayat offices in rural areas are equipped with necessary verification technology. Certified non-governmental organizations assist disadvantaged pensioners with digital certificate generation. Special verification camps are conducted at hospitals for pensioners undergoing treatment. Certificate verification process: digital certificates undergo automatic verification against Aadhaar database records. Physical certificates require authentication by EPFO-recognized officials. Digital submissions typically complete verification within 3 to 5 working days. Paper submissions may require up to 15 working days, depending on office workload. Certificate status can be monitored through the EPFO portal or UMANG application. Successful verification is confirmed via SMS notification.
Scheme Certificate Withdrawal. EPS members with scheme certificates can withdraw funds before completing 10 years of service, but retaining the certificate until pension eligibility is more advantageous. Special provisions exist for orphan children of EPS members. Understanding these options helps you optimize your pension benefits. Withdrawal option: with less than 10 years of service, you can receive a withdrawal payment by surrendering your scheme certificate. Payment amount is calculated based on contributions plus interest according to EPS 1995 guidelines. Be aware that withdrawal is irreversible and eliminates future pension eligibility. Application process: submit Form 10C to your EPFO office, along with your scheme certificate and identity documents. The process typically takes 20 to 30 working days. You must provide your bank details, a canceled check, and an Aadhaar card copy. Application status can be tracked online through the EPFO portal. Pension eligibility: completing 10 years of service qualifies you for an EPS 1995 pension at age 50, early with reduced benefits, or age 58, full benefits. Early pension claims result in lower monthly payments. Members with 20+ years of service receive enhanced pension rates. Certificate preservation: if you leave employment but anticipate future work, retain your scheme certificate. It preserves your service record, which can be combined with future employment periods toward pension qualification. The certificate verifies your service history and facilitates accurate pension calculation at retirement. Double orphan pension: children who lose both parents who were EPS members are entitled to receive 2 separate pensions. Each pension is independently calculated with standard limitations. This provision offers critical financial support for orphan children. Orphan eligibility criteria: children must be under 25 years of age and unmarried. Benefits terminate upon reaching age 25 or marriage. Applicants must furnish proof of parentage and death certificates for both parents. For minor children, legal guardians can submit Form 13, along with guardianship documentation. Tax implications: withdrawals may be subject to taxation under current regulations. The EPFO may deduct tax at source, TDS, before disbursement. Withdrawals exceeding 50,000 incur 10% TDS if PAN details are not provided. Certain exemptions may apply under the Income Tax Act. International workers: distinct regulations govern international workers with scheme certificates. Workers from countries having Social Security Agreements, SSA, with India may have alternative withdrawal conditions. Consultation with the International Workers Cell at the local EPFO office is recommended. Digital certificate management: scheme certificate status can now be verified online through the EPFO portal. Digital certificates have the same validity as physical ones and can be downloaded and printed. Maintaining updated personal information ensures smooth processing of future claims. Certificate restoration: in exceptional circumstances, Those who have already withdrawn benefits may reinstate their scheme certificate by repaying the withdrawn amount plus interest. This requires EPFO authority approval and documentation confirming continuous employment in the organized sector. Defaulting establishments: when employers fail to pay EPF contributions, members face significant benefit restrictions. Members receive benefits only for periods when contributions were properly paid. They have specific options for pension calculation and withdrawal. Under certain conditions, members can also choose to delay their pension beyond regular retirement age to maximize benefits. Withdrawal limitations: if your employer hasn't paid EPF contributions, you cannot receive withdrawal benefits for those specific periods, potentially reducing your total withdrawal amount significantly. Partial benefits: benefits are provided only for periods when contributions were actually made. The EPFO maintains detailed records of contribution periods to calculate your eligible benefits accurately. Calculation method: benefits are calculated separately for each period, with confirmed contributions. Contribution gaps are excluded when determining your total service period, directly affecting your final benefit amount. Recovery process: the EPFO initiates legal action and imposes penalties against defaulting employers. However, this process doesn't guarantee complete recovery of all missing contributions. Member notifications: the EPFO is required to notify members when their employer defaults on payments. Unfortunately, many members discover missed payments only when applying for benefits at retirement. Delayed pension option: you can postpone your pension beyond age 58 in two ways: cease contributions at 58 and receive a 4% pension increase for each year of delay, or continue contributing to potentially earn higher benefits based on extended service. Deferment benefits: delaying your pension can be advantageous if your employer missed payments, as it provides a method to enhance your benefits despite contribution gaps. Legal recourse: members affected by employer non-payment can file complaints with the EPF tribunal. This legal avenue helps protect your pension rights when impacted by your employer's payment failures. Inspection mechanism: the EPFO conducts regular employer audits to identify payment defaults early. Defaulting employers may face prosecution with penalties of up to 3 years imprisonment under Section 14 of the EPF and MP Act 1952. Transfer provisions: when transferring from a defaulting employer to a compliant one, you can't combine eligible service periods for benefit calculations. However, contribution gaps from previous employment will still affect your total benefits unless recovered. Verification process: you can verify contribution payments through the EPFO portal using your Universal Account Number, UAN. Regular verification helps identify discrepancies early, well before retirement. Interest accrual: during employer default periods, your existing EPF balance continues to earn interest at prevailing rates. This helps partially mitigate the financial impact of your employer's missed contributions. EDLI scheme benefits: the EDLI scheme provides up to $600,000 to families when an employee dies during service. Benefits aren't available if death occurs after employment ends. This mandatory insurance offers crucial financial support to families facing unexpected loss. The Employees Deposit-Linked Insurance (EDLI) scheme delivers financial assistance to families when an employee passes away while in service. Established under the Employee Provident Fund Act of 1952, this program supports dependents without requiring any premium contributions from employees. Key benefits and coverage details: maximum benefit, $600,000, the highest amount payable to a deceased member's family, providing substantial financial relief during their time of grief. Minimum benefit, $50,000, the guaranteed minimum amount, regardless of account balance or service duration. Post-service death, none. No benefits if death occurs after employment termination, as coverage applies only during active service and service coverage. Full complete protection while employed and participating in the EPF scheme. No employee cost: employers contribute the entire 0.5% premium based on wages, making it free for employees. Waiting period: employees must maintain membership for at least 12 months before death to qualify for standard benefits. Additional benefit: an extra 50% of the average account balance calculated over 12 months is provided in qualifying cases. Calculation method: the final amount is determined by the higher value between the average EPF balance during the past 12 months or the balance at death. Eligibility: all EPF members receive automatic coverage without requiring separate enrollment, claim process, and documentation to access EDLI benefits. Family members must submit these essential documents to their EPF office. Form 5 if the required claim form, completed and signed. Death certificate: official documentation confirming death and date. Service certificate: employer verification that the member was employed at the time of death. Relationship proof: documentation establishing the claimant's relationship to the deceased. Bank account details: information for direct transfer to the beneficiary's account. Nomination details: the beneficiary designation form. If completed by the employee, the EPFO typically processes claims within 30 days of receiving complete documentation. If the employee didn't designate beneficiaries, legal heirs must provide additional documentation, such as a succession certificate. Employers should assist families throughout the claim process and supply necessary employment records. EDLI beneficiaries. EDLI benefits are paid to the nominated beneficiaries or legal heirs of EPF members, exclusively when death occurs during active employment. All payments are processed through secure bank transfers, providing crucial financial support to families who have lost their primary income earner. Key information about EDLI benefits. Eligible recipients. Benefits are disbursed to individuals nominated in the EPF account of the deceased member, typically immediate family members or legally established heirs. Eligibility period. EDLI benefits are only payable when a member passes away during active employment. No benefits are provided if death occurs after termination of service. Payment method. All disbursements are transferred directly to beneficiaries' bank accounts through NEFT or core banking systems, ensuring secure and efficient delivery. Required documentation. Beneficiaries must submit a death certificate, proof of entitlement, if not nominated, and verified bank account details for processing. Claim procedure. Nominees must file Form 5 if through the employer or directly with the EPFO within 3 years from the date of death. Processing timeframe. The EPFO aims to settle all valid claims within 30 days of receiving complete documentation. Multiple beneficiaries. When multiple nominees exist, funds are distributed according to specified percentages in the nomination form. In the absence of specified allocations, equal distribution applies. Minor beneficiaries. For minor recipients, payments are released to the appointed guardian. If no guardian was designated, legal guardianship documentation must be provided. Claim processing location. Claims are processed at the EPFO office managing the deceased member's account. Families can track claim status online using the member's UAN. Appeal process. Rejected claims are communicated via an official letter with reasons for denial. Applicants may appeal within 90 days to the regional EPF commissioner. Understanding these guidelines ensures families receive timely financial assistance during challenging circumstances. The EPFO has streamlined the process with reduced paperwork to expedite benefit payments. Special considerations for EDLI beneficiaries. Families facing urgent financial needs can request expedited processing by submitting a hardship declaration with supporting evidence. The EPFO maintains a dedicated helpline, 1800 to 2290-133, for claim assistance and inquiries. Beneficiaries residing abroad must provide additional documentation, including endorsement from the Indian diplomatic mission in their country of residence. International fund transfers comply with Reserve Bank of India regulations. The EPFO conducts regular awareness programs to educate employees about maintaining current nomination records. Employers are encouraged to facilitate annual verification of nomination forms to ensure benefits reach intended recipients promptly in the event of an unfortunate circumstance. Universal Account Number, UAN. The UAN is a unique 12-digit identifier that streamlines EPF account management by linking all your PF accounts, enabling online access, and simplifying transfers throughout your career. Permanent identifier. This 12-digit number serves as your lifelong EPF identifier, eliminating the need to remember multiple member IDs as you change employers. Obtaining your UAN. EPFO automatically assigns this number when your employer registers you. New employees without a UAN can create one using their Aadhaar. Employers must register new workers within 30 days via Form 5. Account monitoring. With an activated UAN, you can view and download your passbook anytime. The digital passbook displays all transactions for your contributions, employer contributions, interest earned, and withdrawals. Account consolidation. Link all your previous member IDs under one UAN and transfer funds online, eliminating paperwork and accelerating transfers between employers. Lifetime validity. Your UAN remains unchanged throughout your career regardless of job changes, preventing fragmented accounts and helping consolidate your retirement savings. Digital services, access and emanation, pension withdrawal, profile updates, and request advances or withdrawals directly without employer intervention. Real-time notifications. Receive SMS alerts about contributions, claim payments, and account updates, helping you monitor your savings effectively. Kite verification. Easily update and verify identity documents through your employer or online. Verified documents ensure faster claim processing and paperless transactions. Activation process. Activate your UAN by creating a password and confirming your mobile number. One-time process requiring your UAN, PF number, and registered phone number. Mobile accessibility. Access all UAN services on your smartphone through the UMANG app. Check balances, view passbooks, and file claims from anywhere. Recovery options. Forgot your UAN? Recover it using the Forgot UAN feature on the EPFO website with your Aadhaar, PAN, or member ID, or contact your HR department or an EPFO office. International workers. If covered by Social Security agreements, international workers can manage their PF accounts and withdraw funds according to treaty provisions. Issue resolution, report and track problems with your EPF account through EPFO's online grievance system accessible via their official website. UAN status and balance checking. Access your EPF information easily through the EPFO portal, SMS services, missed calls, or the UMANG mobile app to check your UAN status, view balances, and track claims. UAN status check. Verify your UAN status at https://unifeedportal-mem.ipfindia.gov.in. The portal displays your UAN activation status, KYC verification details, and all linked PF accounts. Maintain security by safeguarding your login credentials and updating your password regularly. Balance access options. View your PF balance by logging into the portal with your active UAN to download your passbook. Alternatives include using the EPFO app, texting IPFAHO UANENG to 7,738,299,899, or making a missed call to 011-229-0106 from your registered mobile number. Your statement displays both your and your employer's contributions plus accrued interest. Claim tracking. Monitor PF settlement, advance, or transfer applications at https://passbook.ipfindia.gov.in. Claim status UAN. Simply enter your UAN and the CAPTCHA to view real-time updates on your claim status and estimated completion date. UMANG app access. Install the UMANG app, available on Android, iOS, and Windows, for a user-friendly interface to check balances, track claims, and view your passbook in your preferred language. EPISBOOK services. Access your comprehensive EPISBOOK at https://passbook.ipfindia.gov.in after UAN login. Review chronologically organized monthly contributions, withdrawals, and interest earnings. Generate customized statements for specific periods, or download your complete history. KYC maintenance. Periodically verify your KYC details, Aadhaar, PAN, bank account, in the UAN portal. Incorrect or outdated information can cause claim processing delays and restrict access to online services. SMS notification system. With an activated UAN, receive automatic SMS alerts about monthly contributions, claim submissions, settlements, and important account activities to monitor your account and detect unauthorized transactions. Support resources. For UAN access issues, balance discrepancies, or claim delays, contact the EPFO Help Desk at 1800-2666-666 or email uanipf@ipfindia.gov.in for assistance with login problems, account information, or claim submission procedures. Regular balance verification. Consistently compare your PF balance against your salary deductions and promptly report any discrepancies to both your HR department and EPFO officials. International worker access. International workers with Indian PF accounts can access UAN services from abroad using standard portals, though special regulations apply for withdrawals and documentation requirements. Job transition transfers. When changing employers, track your PF balance transfer through the UAN portal, eliminating the need for in-person EPFO office visits. Annual statement review. Download and examine your yearly PF statement after each financial year closes to verify all contributions are accurately recorded, helping identify any missing payments or errors that might affect your final settlement amount. Employer-free claims. EPFO members can submit specific claims without employer signatures when their UAN meets certain requirements, using a streamlined single-form process. Signature-free claims. Submit 3 claim types without employer approval: Form 19, Final Settlement, 10C Withdrawal Benefit, and 31, Partial Withdrawal. This expedites processing for members who have left jobs or cannot obtain employer signatures. UAN requirements. Your UAN must be active with your bank account and Aadhaar verified through your employer's digital signature. Your Aadhaar-linked mobile number must match UAN records for verification codes, and your email should be updated for claim notifications. Simplify documentation. EPFO now uses a universal form for all claims, with or without Aadhaar, replacing the separate forms 19, 10C, and 31, significantly reducing paperwork and simplifying the claiming process. Online submission. Submit claims through the member portal, https://unifeedportal-mem.ipfindia.gov.in. After UAN login, the interface provides step-by-step guidance, with options to save partially completed applications. Faster processing. Employer-free claims typically process within 10 to 15 working days, with funds deposited directly to your registered bank account. SMS notifications keep you informed at each stage from submission to final payment. Required documentation. Though employer signatures aren't needed, you may need to upload supporting documents like bank passbook copies, cancel checks, or medical certificates for specific advances. Documents should be clear PDFs under 1 MB real-time tracking. Monitor your claim status through the member portal, or UMANG app using your UAN and claim reference number. The system provides current status updates and estimated completion timelines. Resolution of rejections. Rejected claims include explanations allowing you to address issues and resubmit. Common rejection reasons include data mismatches, incomplete documentation, or ineligibility for the specific claim type. Validation system. Before final submission, the system verifies all required fields and attachments, reducing rejection rates and streamlining the approval process. EPFO membership eligibility. EPFO covers employees in specified workplaces earning below Rs 15,000 monthly, including regular and contract workers, providing retirement savings and insurance benefits. Eligibility criteria. Covered workplaces. Employees working in establishments under the EPF and MP Act 1952 qualify for membership. This includes factories, shops, hotels, and businesses with 20+ workers, as well as theaters, newspapers, educational institutions, hospitals, and profit-making cooperative societies. Wage calculation. Eligible wages include basic pay, dearness allowance, and regular allowances. Commission-based payments and performance incentives also count toward your EPF wage. Contract workers. Individuals hired through contractors are covered under EPFO. If contractors fail to pay EPF contributions, the principal employer becomes responsible. Principal employers must monitor compliance and can recover these payments from contractor fees. Wage ceiling. New employees earning above Rs 15,000 monthly aren't mandatory members. However, existing members can continue with EPFO even if their salary later exceeds this threshold, ensuring continuous coverage. Voluntary membership. High-earning employees can opt into EPF with employer consent. While employers may limit their contributions to the ceiling amount, voluntary members receive the same benefits and can contribute based on their actual salary. International workers. Foreign nationals working in covered Indian establishments join EPF without wage restrictions, subject to Social Security agreements. Their withdrawal rules vary based on bilateral agreements with their home countries. Exempted categories. Government employees. Central and state government staff already covered by pension benefits under their service rules. Foreign nationals. Citizens from countries having Social Security agreements with India who contribute to their home country's Social Security system. Apprentices. Individuals undergoing training under the Apprentices Act 1961 during their apprenticeship period. Registration process. Universal Account Number, UAN. All eligible employees receive a UAN, serving as their permanent identifier throughout their career. Required documents. Valid ID proof, Aadhaar PAN voter ID, bank account details, and a canceled check for verification. KYC verification. Employer verification of KYC details is essential for full activation of EPFO benefits. Mobile number. A valid mobile number linked to Aadhaar enables alerts and access to online services. Upon registration through the UAN system, members receive a lifetime account that tracks all EPF contributions throughout their career. This UAN remains unchanged even when changing employers, facilitating seamless EPF balance transfers. EPFO membership provides a comprehensive financial safety net for India's organized workforce through 3 key benefits: retirement savings via EPF, pension through the Employees Pension Scheme, EPS, and life insurance coverage through the Employees Deposit Linked Insurance, EDLI, scheme.
Contribution rates. Employees contribute 12% of their wages to EPF, while employers match with 12% distributed between EPF, 3.67%, pension fund, 8.33%, and an additional 0.5% to EDLI. Standard contribution structure. Employee to EPF, 12% deducted from the employee's basic salary plus dearness allowance. For example, with a Rs 20,000 basic salary, the monthly contribution would be Rs 2,400. Employer to EPF, 3.67%. This portion of the employer's contribution goes directly to the employee's EPF account. For a Rs 20,000 basic salary, this amounts to Rs 734 monthly. Employer to pension fund, 8.33%. This portion of the employer's contribution is allocated to the employee's pension fund. This is capped at a maximum wage of Rs 15,000. Resulting in a maximum pension contribution of Rs 1,250 monthly. Employer to EDLI, 0.5%. This additional employer contribution funds life insurance coverage through the EDLI scheme, providing up to Rs 7 lakhs to beneficiaries in case of the employee's death during service. In summary, employees contribute 12% of their basic salary to EPF, Employers also contribute 12%, allocating 8.33% to the pension fund, and 3.67% to EPF, plus an additional 0.5% for life insurance coverage. Important points to know. Calculation limit. While employee contributions are calculated on actual salary, pension contributions are capped at Rs 15,000 per month, unchanged since 2014. Administrative fees. Employers pay an additional 0.5% as administrative charges to support EPFO operations. Tax benefits. EPF contributions qualify for tax deductions under Section 80C, with interest earned remaining tax-free up to specified limits. Interest rates. EPF typically earns higher returns than regular savings accounts, ranging between 8.1% and 8.8% in recent years. Regional variations. Certain regions, including Jammu and Kashmir and northeastern states, may operate under slightly modified regulations. Special allowances. Regular special allowances must be included in the wage calculation for EPF contributions. Reduced rates for specific industries. Labor-intensive sectors, such as brick manufacturing, jute, Beatty, coir, and guar gum factories, are eligible for a reduced 10% contribution rate. This integrated system delivers 3 essential benefits: retirement savings through EPF, pension income through EPS, and life insurance protection through EDLI. How contribution rates have changed. The EPF contribution rate began at 6.25% in 1952, when the EPF Act was established, gradually increasing to the current 12% to enhance retirement benefits. Future developments may extend coverage to include gig workers and emerging employment categories. Understanding these contribution mechanisms enables effective retirement planning and ensures you receive all entitled benefits under the EPF scheme, which stands as one of India's most comprehensive social security systems. Members can contribute beyond the mandatory 12% to enhance their retirement savings, while still receiving their employer's full contribution, creating an excellent wealth-building strategy over time. Voluntary higher contributions above required rate. Members can voluntarily contribute more than the standard 12%, significantly boosting retirement savings through systematic investing. Voluntary Provident Fund, VPF. These additional contributions are integrated into the same EPF account, streamlining retirement fund management. No extra employer obligation. While members can increase their contributions, employers only need to maintain their mandatory 12%. Nevertheless, the guaranteed returns and tax advantages make VPF a compelling investment compared to alternatives. No upper limit. There is no ceiling on additional employee contributions through VPF, enabling higher-income earners to substantially increase their tax-efficient retirement savings based on their financial capacity. Consistent interest rate. VPF contributions earn identical interest as standard EPF contributions, currently 8.15% annually. This rate typically exceeds fixed deposits and many other secure investment options. Tax advantages. VPF contributions qualify for tax deductions under Section 80C up to 1.5 lakh annually. The accrued interest remains tax-free until withdrawal, subject to certain conditions, providing exceptional tax efficiency. Simple enrollment. Members can initiate VPF by submitting a straightforward form to their employer indicating their desired additional contribution. Most HR departments provide ready-made forms for this purpose. Flexible adjustments. Members can modify their VPF contribution percentage at the beginning of each financial year to accommodate evolving financial priorities and objectives. Compounding benefits. The combination of increased contributions and tax-free interest creates a powerful compounding effect over time, substantially enhancing the retirement corpus. Automatic savings discipline. Since VPF is deducted directly from salary, it fosters disciplined saving habits and ensures consistent long-term accumulation without requiring active management. Conditional access. While primarily designed for retirement, VPF funds can be partially withdrawn for specific needs such as medical emergencies, home purchase, or children's education. Family security. In case of a member's demise, the entire VPF balance transfers seamlessly to nominated beneficiaries without complicated legal procedures, providing immediate financial protection for family members. Strategic advantage. This mechanism allows members to build a more substantial retirement fund while continuing to receive their employer's mandatory contribution, creating an advantageous arrangement for long-term financial security. Voluntary hire contributions represent one of the safest and most tax-efficient methods to augment retirement savings with government-guaranteed returns. Members should evaluate their overall financial goals and liquidity requirements before increasing their contribution rates. For those with adequate emergency reserves and a long-term perspective, VPF offers a unique combination of security, competitive returns, tax benefits, and convenience that few alternative investment vehicles in India can match. Financial experts frequently recommend maximizing VPF contributions before exploring market-linked retirement options, particularly for risk-averse investors or individuals in higher tax brackets who derive maximum benefit from the tax advantages. By consistently directing additional funds to VPF throughout one's career, members can potentially accumulate several additional lakhs or even crores in their retirement savings. EPF member benefits. The Employees Provident Fund offers comprehensive benefits, including retirement savings, financial assistance during specific life events, and insurance coverage that supports members throughout their career and retirement years. Final settlement. When you retire or 2 months after leaving your job, lump sum payment of your accumulated contributions plus earned interest tax exemptions available when withdrawing after 5 years of continuous service. Flexibility to withdraw partially while keeping your account active. Pre-retirement access to 90% of your balance 1 year before retirement. Standard processing time of 20 to 30 days after complete application submission. Advances accessible funds for specific needs during employment. Medical treatment for self and family members, up to 6 months salary. Home purchase or construction, up to 36 months salary. Marriage or education expenses, up to 50% of your contribution share. Financial relief during natural disasters, up to 50% of your share. Unemployment support, up to 75% of balance after 1 month of job loss. Special COVID-19 advance during pandemic, up to 3 months salary. Insurance and pension, retirement income security and protection during service. Regular monthly pension through the Employees Pension Scheme. EPS assured minimum pension of 1,000 per month. Life insurance coverage up to 7 lakhs. Nominee benefits in case of member's death. Option for partial commutation of pension as a lump sum. Family financial security through return of capital. Option transfer and portability. Seamless EPF account transition between employers. Streamlined online transfer process through universal account number. UAN, preservation of continuous service period for benefit calculations. Automatic transfer capabilities when both employers are EPFO integrated. Consolidation option for multiple PF accounts. International worker provisions for cross-border employment. Digital services, modern account management platforms. UAN portal for balance verification and claim submissions. Dedicated mobile application for convenient EPF service access. Real-time SMS alerts for significant account activities. Digital passbook for tracking contributions and interest accrual. Paperless online claim submission with expedited processing. Aadhaar-based SN functionality for seamless transactions. Non-refundable advances. EPF members can access funds before retirement for specific life events without repayment obligations, providing crucial financial support during important life situations. EPF members can withdraw money from their accounts during service for various needs. These non-refundable advances help members address financial requirements before retirement. Medical treatment, available for treatment of self, spouse, children, or parents with a doctor's certificate. Withdraw up to 6 months' wages are the actual medical expenses, whichever is lower. Required documents include doctor's certificates and cost estimates. Urgent cases are processed within 7 to 10 working days. Marriage, accessible for your own marriage or for children's siblings. Withdraw up to 50% of your contribution with interest after completing 7 years of service. Submit marriage invitation, relationship proof, and a declaration form within 3 months of the ceremony. Processing typically takes 15 to 20 days. Education supports higher education for self, children, or siblings. Access up to 50% of your share with interest after 7 years of service. Required documents include admission letters, fee details from recognized institutions, and relationship proof if for dependents. Covers tuition, accommodation, and educational materials. Housing assists with purchasing, constructing a house, repaying housing loans, or making home repairs. Withdraw up to 36 months' wages are the total cost, whichever is lower, after 5 years of service. Submit property documents, construction plans, loan statements, or repair estimates. Can be withdrawn in installments based on construction progress. Pre-retirement needs, available within 12 months of retirement. Access up to 90% of your total balance. Submit an employer certificate confirming your retirement date. Facilitates transition, planning to post-employment life. Processing completed within 10 to 15 days. During unemployment, Available after 1 month of unemployment. Withdraw up to 75% of balance or 3 months' wages, whichever is lower. Submit an unemployment declaration and employment termination documentation, limited to one-time use during unemployment to support living expenses while seeking new employment. Natural disasters, available during floods, earthquakes, or other calamities. Access up to 50% of your share with interest. Submit a certificate from local authorities confirming the disaster's impact on your residence or livelihood. Expedited processing within 7 days for immediate relief. COVID-19 Special Advance. Implemented during the pandemic, permits withdrawal of up to 3 months' wages or 75% of balance, whichever is lower. Established under government relief measures. Requires only a simple self-declaration of COVID-19 impact, with minimal documentation requirements. Documentation requirements and processing timelines vary by advance type. Apply through your employer or directly via the EPFO portal with appropriate supporting documents. Most advances are processed within 15 to 30 days of complete application submission. Consider that substantial withdrawals from your EPF may significantly impact your retirement savings. Utilize these advances judiciously, carefully balancing immediate needs against future financial security. EPFO continuously refines these provisions based on member feedback. For expedited processing, ensure your Aadhaar, PAN, and banking details are current in EPFO records. Approved advances are transferred directly to your registered bank account. Monitor your application status through the member portal or by contacting the EPFO helpline. Online Member Services. EPFO offers secure digital platforms where members can monitor their accounts, view detailed statements, submit paperless claims, and transfer funds when changing employers, for making PF management seamless, accessible, and transparent. EPFO provides these comprehensive online services to empower members with easy PF account management. Member portal. Access your PF information instantly with your UAN and password. Track contributions, download official certificates, and update personal details through this user-friendly interface available in multiple regional languages. Digital Passbook. Monitor your PF balance in real time, with transparent tracking of employer and employee contributions, accumulated interest, and any withdrawals. Generate customized statements monthly or annually to maintain accurate financial records. Online claims. Submit claims digitally by linking your Aadhaar, PAN, and bank account. This streamlined paperless process delivers faster results than traditional methods, with real-time updates via SMS and email. The intelligent system auto-populates most information, minimizing potential errors. Account transfer. Seamlessly transfer your PF funds when changing jobs without cumbersome paperwork. Your UAN effectively consolidates all employer contributions, creating a unified and continuous retirement savings record emanation. Designate your beneficiaries digitally to ensure your hard-earned funds reach the intended recipients in case of unfortunate circumstances. Add multiple nominees, specify allocation percentages, and modify details whenever necessary. Pensioner services. Submit your digital life certificate, review pension statements, and monitor regular payments after retirement. Access your complete payment history, download tax-related documents, and resolve pension queries through an intuitive, senior-friendly dashboard. Umang app. Access all essential EPFO services conveniently on your smartphone. This versatile app functions offline for viewing saved documents, incorporates fingerprint authentication for enhanced security, and delivers instant notifications about contributions and claim status. ECIC service. Authenticate your identity electronically using Aadhaar and biometric verification. This eliminates the need for physical document submission and expedites service delivery significantly. Missed call service. Check your PF balance instantly by simply giving a missed call from your registered mobile number. Receive an immediate SMS with your current balance, for particularly valuable when internet connectivity is unavailable. These advanced digital services demonstrate EPFO's commitment to enhancing member experience through innovative technology. The organization continually refines these platforms based on member feedback, with upcoming features, including AI-powered chatbots, expanded language support, and integration with other government financial services. EPFO aims to achieve complete paperless operations, while maintaining robust security and privacy standards for all member data. Claim forms and submission. EPFO provides both online and offline claim filing options. Members with properly linked accounts can enjoy a convenient digital process, while traditional paper forms remain available for all claim types. EPFO offers multiple ways to submit your claims. Online submission. File claims paperlessly through the composite claim form if your PF account is linked with Aadhaar, PAN, and bank account. This streamlined process typically completes within 15 to 20 days. Simply log into the unified portal, unifiedepfindia.gov.in, using your UAN and confirm your submission with an OTP sent to your registered mobile number. Offline options. Submit any type of claim using these specialized forms. Form 19 Final PF Settlement upon retirement or resignation. Form 10C Pension Benefit Withdrawal or Scheme Transfer. Form 31 Partial Withdrawals for Education, Marriage, Medical Needs, etc. Form 10D Monthly Pension. Submit 6 months before retirement. Form 13 PF Account Transfer when changing employer's bank account updates. Maintain accurate bank details through the member portal, subject to employer approval, to ensure successful payments. Required documents. Prepare self-attested supporting documents based on your claim type, such as resignation letters or medical certificates. Claim tracking. Monitor your claim status through the unified portal or by contacting your regional EPFO office, with updates delivered via SMS and email. Processing timeline. Expect online claims to process within 10 to 15 days, and offline claims within 20 to 30 days, with EPFO targeting a 20-day settlement window. Joint declaration form. Submit this employer countersigned form if you have less than 5 years of service to avoid tax deductions on PF withdrawals. Avoiding rejection. Ensure all personal details match official records. Verify bank information accuracy. Include all required signatures, and submit complete documentation. Complete all forms with precision to prevent processing delays. Maintain copies of all submitted documents, and claim receipts for your records. EPFO provides a dedicated system to address any settlement issues or delays you might encounter.